off the fancy airplane were with people with foreign accents. Immigration is critical to the spirit of this nation. It's hugely contentious. I want you to describe, as Powell speaks, as Biden moves forward, what they do with our three Americas, the haves, the have-nots, and the immigrants that are keeping us going.
Well, you're raising an extraordinarily important part that even among immigrants, there's wide disparity. There's skilled immigrants. There are people who come to go to college in America or graduate school and stay, particularly in the tech industry, for example. And then there are immigrants that are working the sort of lowest wage jobs in a lot of our industries and our sectors. Some are documented, some are not. So there's generations now of immigrants. So even our political assumptions about how different ethnicities or nations of origin people vote, that's changing all the time, because it's not just first generation or even second generation now. We're talking about third and fourth generation who have very different views than their parents or grandparents. So the politics and the economics are really every year are getting more and more disparate. They're really different, particularly where people live across the country.
What have you learned in the recent days, the recent weeks, the primary season, as we move to the midterms and critically to 2024? What is the power for the president, the power for the chairman of immigrants, first generation, the kid from Belarus that drove me yesterday, the people in Pueblo, Colorado as an example, the Latino vote there that's shifting dramatically Republican? What's their power that you've learned about?
Well, one of the most important things is that when you are an immigrant and you are not yet a citizen, for example, you obviously have different political rights, but immigrants do not qualify for federal benefits, or usually state benefits, unless you have relocation assistance, meaning they have to work for whatever they have. So when you see the Biden administration doing things like forgiving student loans, which we could talk about, for people who go to college, less than 40% of America goes to college, 60% doesn't go to college, and you are not eligible for any of these benefits that you see being given away, that sticks with you. That stays with you as you go through the naturalization process and become a voting citizen. So I think that's what the Republicans figured out, is that Democrats think immigrants will be for them because of the rhetoric, particularly for Donald Trump, among others, but in fact, immigrants tend to go the other direction because they say, well, we work for everything we have, we're not eligible for anything, and you're giving our money away. So I think that is a big divide, and I think it's a chronic and growing misperception by the Democrats.
Let's talk a little bit about the student loan relief that we heard about from yesterday from President Biden. A lot of people are saying this is going to help heading into the midterm elections. What's your view on how inflation muddies the water and the estimates from a whole host of different shops, partisan and bipartisan, that this will be somewhat inflationary on the margins?
Well, I think most people vote when they have an axe to grind or they're really enthusiastic. So we know that Republicans have an axe to grind, and we know that people who are suffering from inflation, gas prices, and many of whom may not have gone to college or aren't in college or paid off their student loans already will not benefit from this at all. So, if you're going to raise the deficit a little bit, you're going to add to inflation. That rhetoric helps the Republicans. And people who are college educated, the Democrats have a majority of those voters now. They're voting Democratic anyway, and we don't know how enthusiastic they are. So I'm not sure this $10,000 or even $20,000 gets them out the door to vote. And lastly, students who are in college, states have done a pretty good job, particularly Republican-controlled states, of limiting their ability to vote. Their residency requirements, making it more difficult for them to vote if they're not there full time. So in some ways, you're not even going to get that student vote that you hope to get from this move.
Wendy, you're a dyed-in-the-wool Democrat, and you also are at a university that is very prestigious and known for its academic prowess. Do you think that this is a good policy for getting prices of tuition lower, or do you think it inflates it further?
Well, Lisa, first of all, registered independent, so there's my political affiliation for you. I think that university costs are outside my lane. I'm a research and teaching professor, but every business, and higher education is a business now, raises its cost depending on how much money it can make. So if, in fact, loans are forgiven and there is a greater possibility of affording college, then there isn't any reason really for universities to cap their prices. So I think the whole student loan system, contributes to the rise in tuition that universities charge. And like any other business, it's a competitive, consumer-driven business now. They're going to raise their prices when they can.
Wendy Schiller of Brown University. I apologise for my colleague. We're all independent and impartial around here, Lisa. Did you know that?
Sorry,
Did you know that? You
I
can't-
didn't.
you can't-
I didn't
you
mean to
can't accuse guests of being
I wasn't accused her.
being
I
affiliated
just
with a
know that
political
she's.
party.
I'm not. I'm going to stand down. I'm going to go get eaten by a bear now.
We can talk about the
Please.
price of Brown University,
Please.
though. And TK, I think we've got to do that.
We've got to do it.
Let's
How
touch on the
about,
heart of the problem, and Bramo's done it several times this week. It's the price of college tuition in America.
okay, you ready? All in Brown University, $80,448 per year.
A year.
And that doesn't include Wendy Schiller's classic textbook.
But that is for a university that is highly respected and where a lot of the people who go have more money to spend. This is the issue when you have for-profit universities and people not completing those degrees and whether they get the jobs afterwards that give them the salaries that make it worthwhile. And this is a larger structural problem. It is a massive one. How do you get it done? Unclear.
I tell you, people in the UK falling off their seats listening to some of this. 9,000 sterling domestic to go to Oxford or Cambridge. And I'm hearing 80,000 US. 80,000 US.
John, let's bring this down. Leeds Chelsea, worst own goal ever by the
that's the important
goalie.
stuff. Well
and
done.
the bottom line is this a massive own goal for President Biden? That's
We'll see,
really what
Tom.
this is about.
Yeah, that's
We'll
a
see.
Do you
good
like
point.
that soccer talk?
That was beautiful.
No one in Wyoming plays
so
soccer.
proud of
No
you.
one. There is.
You don't know that.
Wyoming is
You don't
soccer
know
free.
that.
We know
you
this.
don't know that. Live from Jackson Hole, the important stuff. This is Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
I think it's really reasonable to think that core inflation could surprise people to the downside.
You're seeing inflation expectations rise quite meaningfully across the globe.
That acceleration that we've seen in wages, you'll probably see that showing up in prices. So we could actually accelerate in some components of inflation.
What's very, very unique about this cycle is that recession risks and inflation risks are at odds with each other with respect to policy.
We're on the cusp, or we're in a global recession as we speak.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from Jackson Hole, Wyoming, for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow, with equity futures just about positive. It's the drumbeat, TK, going into Chairman Powell tomorrow.
Into Chairman Powell tomorrow, and it's the two Americas of a booming Wyoming that we're seeing. And we saw that coming in here through the airport, and the prosperity of a Wyoming that's part of a booming West, even within drought. And that's part of what he has. He has a productivity dearth, no question about that. He's got massive data dependence, and it's how does he speak to the tension. You mentioned earlier the Bloomberg article of 1 in 6 Americans having trouble paying their electric bills. That's the core issue right now.
How does he speak to the data point at the moment, Lisa? 8.5% CPI in America.
And the fact that this is going to have and is already having a ramification that people are feeling. You're seeing on the margins people changing what they eat, what they buy, how they travel because of that 8.5% inflation, which goes to the momentum that you talk about, Tom, and how quickly does it fade?
Well,
how do you speak to tomorrow with the strength of today?
And who does he speak to? Last night to greet Jacob Frenkel, the former governor of the Bank of Israel, iconic within foreign exchange academics. John, does he speak to an international audience, including talk about challenges, Governor Bailey, the Bank of England?
I think it is tremendously difficult for this chairman to navigate the problems abroad with so many problems at home. If he's worried about having his message being misinterpreted, I think that the greatest route to go down to really confuse things is to start talking about Europe, start talking about China and everything else that's happening on the planet. He's got an inflation problem. Does he have a market problem as well? And we need to talk about that too. This equity market bottomed on June 16th. And since then, until very recently, we had equity markets to the moon, Bremo, and we had credit spreads tighter. And we need to ask whether we've seen an unwarranted easing of financial conditions relative to what they need to do to get CPI inflation back in.
And in the previous communication, he did not push back dramatically against that market action. Does he do that now, especially considering the fact that we're looking right now at markets that are pricing in, they're moving away from some of the rate hiking target?
Since when does a central bank leader jawbone markets?
Are you kidding me?
They don't. No,
Where have you been the last 10 years?
This is an academic. I just don't think he's going to come out and say the markets are wrong. He's just not going to do that.
They've been doing that for the last 10 years. They've either been validating things, running away from things. Tell me what happened in late 2018, December 2018. What happened?
Red Sox traded for
Bogarts, I think. Come on. We all know what happened in the market and how it changed policy for this Federal Reserve.
Okay, the market changed policy, but the idea that a central banker is going to lecture the markets at Jackson Hole, I just think is not correct.
Lisa, it would not be the first time.
It would not be the first time, especially because financial conditions are the mechanism that they use to transmit monetary policy to the rest of the economy. That's one big issue.
Are you doing moose noises again? Is that what it was?
No, that's a bison noise.
That was a bison. Sound effects through today? Okay, just to confirm for everyone, we're not inside because of bears and bison.
Because we have one.
Yeah.
We're inside because the weather's so bad. The team put together a little mini studio for us inside the lodge where Chairman Powell will be walking around a little bit later. And hopefully if the weather gets better, we'll be going back outside.
Can you be honest and tell them the truth? I did an all-nighter, folks, with some of the great people here, and they just set up the studio inside.
Let's frame the difference between Tom and I. We're at a diner scene. Okay, we walk in, bow tie, suit, tie. Cowboys just lined up.
Like
honestly, and they're just like ripping off his bow tie. I'm taking off my tie. Esther George looks up at us and goes, "Here come the New Yorkers." Walks over, welcomes us. TK sits there, 2 martinis in front of him, and the Kansas City Fed shout over to me, "Are you going to look after Tom tonight?" What do? I go home and go to bed. I have no idea what happened to this one in the hours after that.
There was very careful analysis of the Fed.
Was there? I'm sure there was. I look forward to the coverage on that. And let's hope you're dialed in and read it, I'm sure. Futures right now, they are positive 0.5% on the S&P 500. Lisa, the bond market, it's been about yields higher just yesterday. Yields coming in at the front end. We're down 2 basis points, 337 on a 2-year.
All right, so today, obviously, we're in Jackson Hole. It is day one, and we've got a whole host of great guests, including Esther George, who I'm sure will be checking in on Tom, Seth Carpenter, and Megan Green also joining us. 8:30, we get initial jobless claims, and this is Eastern time, not where we are right now. But how much do we get a read from the labor market of a softening, and how much is this really what the Fed is looking for? And there are a whole host of retail earnings today, and I know that, Tom, you were skeptical about Dollar Tree, Dollar General, why we care. This is the other half. This is where people shop when they're looking for a bargain. We're also getting Gap and Williams-Sonoma as well as Ulta. But how much do we get a sense people are pulling back from their spending? We saw this already at a whole host of different companies, including Nordstrom, even the higher end, seeing that.
Have we all forgotten that headline from Walmart earlier this month? Walmart came out and said high-income, middle-income Americans are now coming to Walmart. That's a big change, Tom. High-income Americans going to Walmart because it's not just low-income workers getting squeezed. To your point, and you've made this over the last several months, people are looking at the bills and they're looking to go elsewhere. Own brand, store brand products, that's where a lot of business has been done.
The gloom, who brought the gloom fest here? Marco Kolanovic, who's, measured.
Okay.
Is he a mentor?
Okay, JP Morgan, he's measured, and he talks about a glide path down in inflation solved by a lessening of supply-side shock, like something Dean Hubbard would talk about.
You're really scraping the barrel for the bulls if you're going to the perma bulls.
If I'm not doing it for the bison, I'm doing it for the bulls. Are there bulls out here?
Let's get to the theme of the moment in Jackson Hole, Wyoming. Here's the title: Reassessing Constraints on the Economy and Policy.
Very good.
Let's have that conversation now with Glenn Hubbard, the Professor of Finance and Economics at the Columbia Business School. Glenn, great to have you with us, sir. Can you frame how challenging this moment is for this Fed chair?
Well, I think it's very challenging for two reasons. One, it's a momentous time in the economy with both significant uncertainty about inflation and recession. Two, it's important for him and communication. I actually have a old whip inflation now button here from the Ford administration. And I think Chair Powell needs to do a bit better in expressing some candor about the past, not necessarily a mea culpa, but for what happened, and about the future, what it's going to take, as well as talking about the difficult path of getting inflation all the way back down to 2%. Getting it down to 4% may be straightforward. Getting it to 2% much harder.
Glenn Hubbard, the arc of Republican economics represented by so many here at Jackson Hole is that the system will solve itself. Is a general statement, is the religion of supply-side economics or the religion that the American economy can heal itself, has that failed?
I don't think so. I mean, the economy has a lot of self-equilibrating mechanisms. The question is over what time period and in the presence of such large shocks. I think policy still has a role to play. It had a role to play in the COVID pandemic, and the Fed just can't wait to let inflation work itself out.
So, Dean Hubbard, Glenn, what's your view on our debate that we were just having about whether this Fed chair will speak to markets, what he will say about their enthusiasm about some sort of pivot or some sort of pause in Fed rate hikes?
Well, I think the message he could give, going back to the point I said about candor, about where we have to go, is what it would take to reduce inflation. I don't think he's literally going to lecture the markets and say the stock market's too high or something like that. But I think he could outline a path that says we have work to do. Getting that work done requires tighter financial conditions. Speaking in general terms, I think that would be wise to make that kind of communication to the public and to the markets.
There was an article in the Wall Street Journal, I keep mentioning this because it really caught my attention, about whether we have seen the end of the low rate policy. This is what PIMCO has put out there. And the possibility of inflation remaining high for a longer period of time due to a deglobalization, due to structurally higher commodity prices, due to a lack of investment over the past few years. Do you buy into this theory? And if the Fed does, what does that mean in terms of how high rates have to stay and for how long?
Well, I think there's certainly something to the fact that we have demographic changes, structural changes, globalization changes. I'd be hesitant to draw straight lines and say that's just going to be permanent, but I think it's definitely something to watch. To my mind, the concern for the Fed ought to be is probably two worlds. One in which we keep inflation expectations anchored around 2%, the other in which they go off kilter. And I think that's the challenge the chair faces, and you'll have to, quote, do what it takes to make that happen.
Hey, Glenn, thank you, sir. It's good to hear from you, as always.
My pleasure.
From Columbia Business School. That's been a theme that's come up multiple times over the last week, the last few months on this program, and I don't think that theme's gone away. How much weakness is this Fed willing to tolerate? What's the price of GDP that they're willing to pay, Tom, to get inflation back down towards target?
This is important. We double-barreled that yesterday, in that there's a growth dynamic and a labor dynamic. That's the politics of it. How much will they tolerate? And the backdrop here, which we don't talk enough about, is productivity. And as a triple ratio, there's a lot of dynamics in this fancy word productivity, and it's a mystery now how we jumpstart American productivity.
We were fortunate to catch up with Jan Hatzius of Goldman earlier this week, and the point that he was making essentially, Lisa, is that the bar to cut, the hurdle, is really, really high. And effectively what we have to be discussing is not the hurdle to cut interest rates, it's the hurdle to pause.
Yes.
At what point do they pause this hiking expedition, if you want to call it that? Pause and wait. Pause and wait. Raise and hold, I think, is going to be a phrase you hear a lot this week.
Wyoming is a good time for an expedition. I guess a rate hiking expedition actually makes perfect sense. Look, it's not just that, but also for how long do they pause? And this, to me, I think was the Jan Hatzius key point, which is it could be for years, because that is where this economy is at in terms of inflation and strength.
Jan was talking 2 years, maybe at 3.5%. And the animal noises, you done? You want to squeeze one in? What was that? What was that?
That was the golden eagle.
Okay. Mohammed, if you're out there, you can postpone this appearance. We'd prefer that you stay with us, though. Mohammed Al-Arian of Bloomberg Opinion and a whole lot more is going to be joining us in about 50 minutes' time. Looking forward to it. From Jackson Hole, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Atlanta Fed President Raphael Bostic says that more strong data could lead the central bank to raise interest rates another 0.75 percentage point. Bostic told the Wall Street Journal it's too soon to say the inflation surge has peaked. Tomorrow, investors will be listening to Fed Chair Jerome Powell's speech at Jackson Hole for clues about what the Fed will do at next month's policymakers meeting. China has stepped up its attempts to stimulate the economy. It's adding $146 billion of spending, largely focused on infrastructure spending. That won't likely go far enough to counter the damage from repeated COVID lockdowns and a property market that is slumping. There is more pressure on consumers over in France and Germany today after power prices rose to record highs. They're now about 10 times higher than what they were a year ago. The astronomical rise is being driven by tighter gas supplies from Russia that pushes up the price of gas that fuels Europe's power stations. In Uvalde, Texas, a school board has fired the school police chief following that mass shooting in which 19 fourth graders and 2 teachers died. An investigation described Pete Arredondo as the commander responsible for police response. Law enforcement waited outside the school for more than an hour whilst the gunman was inside. Peloton reported fiscal fourth quarter revenue that missed estimates. There was a big loss in the quarter as well, $1.2 billion. But the fitness company says that $415 million of that is going due to the ongoing restructuring. Peloton's number of connected fitness subscribers also was lower than expected. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different, Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
The markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Raising interest rates doesn't solve the supply side problem. It can even make it worse, because what we want to do right now is invest more in the supply side bottlenecks. But raising interest rates makes it more difficult to make those investments.
Joseph Stiglitz there, the Nobel laureate in economics, catching up with us in the last couple of days. Live from Jackson Hole, Wyoming this morning. Good morning to you all. Your equity market's shaping up as follows. Futures just about positive on the S&P 500. TK, yields higher yesterday. Yields back in today, just a couple of basis points. No real drama here as we set things up for a lot of Fed speak, a ton of Fed speak through the next 48 hours.
The VIX came in, John, 24 to 22, which I think is important as a calming influence into the speech. But both you and I noticed a 3.40 2-year yield speaks volumes.
Interesting, isn't it?
That's a 10-day move that's tangible.
Seeing it at the front end of Germany too, something we keep picking up on. Not seeing that translate into any real currency moves for the Europeans though.
But that's the real takeaway. What will it take for the currency to strengthen? And then without that kind of follow through, what can the ECB do in light of the fastest inflation in decades? How do they counter that with policy?
Well, the zeitgeist of the last 3 days, Steve Englander is one example, is okay, you can make a weak dollar call, except you can't. And the resilient or even stronger dollar call seems to be the zeitgeist.
But what are we doing here through the next couple of days? And I know what we're doing here, so I'm not just saying, I'm not trying to make a point here. It's the road to September 21 and the Fed's next meeting, and beyond through next year as well, and perhaps even longer. We need to talk about September 8th and the ECB. I think September 8th in the ECB, we've got people essentially saying Germany, it's not about if they go into recession, it's about how deep that recession is. And you've got a European Central Bank that's set to hike another 50 basis points in a couple of weeks' time.
And Kit Hughes was really terse about this at SocGen. He said it's just about energy. And Steve Shork, who's encyclopedic on this, was adamant that energy in Europe matters to our American viewers and listeners.
I noticed Kit Hughes at SocGen just published moments ago. Effectively, the title essentially was, the news is dire, but is it any worse than expected? And that's the market question, isn't it? Now, we can all talk about the economist question, which is, how bad is the economy? For the market, is it better or worse than expected?
Well, I think that it's as simple as that. And in the politic landscape, it is just the same. Is it better or worse than expected? Get out the calendar, and the calendar is simple. The September and November elections await. Jack Fitzpatrick joins from Washington right now. Jack, what is happening right now at the White House in terms of politics of September?
The politics of September, big picture, the White House is trying to accomplish everything it can, especially looking at the student loan forgiveness measure to deliver for probably more Democrats, their supporters who may wane or wax in enthusiasm heading into the midterms, probably more of those Democrats even than persuadable voters to try to get their supporters to turn out in November, and also understanding that they may not have that many opportunities in future Congresses.
Jack, in Pennsylvania, it's Fetterman against Oz. Are you telling me student loan debates matter over a choice there?
Well, that's what I'm getting at is I don't know the choice between Fetterman and Oz is going to come down to someone's views on student loan forgiveness. I think the focus on this kind of thing is doing what they campaigned on and giving Democrats something to be enthusiastic about, because in a race like Fetterman versus Oz in Pennsylvania, it's a truism to say it all comes down to turnout, but it seems especially true in a lot of these key races that if the Biden administration can give their Democratic supporters something to be enthusiastic about, that may be more politically valuable to them than going for the swing voters that may or may not really exist in a race like that.
Meanwhile, perhaps the number that we are all watching most closely is 71 days. That is how many days the gasoline price, or petrol price, some might say, has fallen in the United States. And how much is this really driving what we saw on 538, which is a more than 60% chance now being priced in the Democrats are going to keep the Senate?
Yeah, gas prices play into that. If inflation can wane at all from now to November, that would be a good thing for Democrats. It's still a matter of the economy overall on net being a weakness for Democrats. When you look at a number like that from 538 on the Senate outlook, keep in mind even Mitch McConnell has said probably a 50-50 proposition on which party ends up controlling the Senate, and he said candidate quality is an issue. Oz in Pennsylvania has had some bad polls. There have been complaints about how much he is or isn't on the campaign trail. They have not gotten moderate swing state members to win Republican primaries in Arizona. Blake Masters, it's a lot of Trump loyalists who lately have had some disappointing polls on the Republican side. So it may be gas prices. It may come down to a few weak candidates on the Republican side letting their side down and giving Democrats more of a chance than you would normally imagine in this kind of midterm.
Hey, Jack, we've got to leave it there. Jack Fitzpatrick of Bloomberg Government down in Washington, D.C. It's for me, Lisa, I get confused between nat gas and gas and what we're talking about. I'm not
look,
saying
I
say
think
petrol.
we could say,
I'm not
we could
saying
say
petrol.
okay, but we could say
Just,
gasoline. No,
gasoline,
I think that that's fair.
I'm
but
on
I
board.
think that actually there was a really interesting report that I was reading, and I'm just going to geek out for a second about how
Is this new? An original moment?
This is just for the moment, as Tom practices his Buffalo noises. How much we see the other side of the Strategic Petroleum Reserve release when it ends over in September, in October. How does that change the 71-day streak that we've seen?
Can I bring some perspective into this of where we are?
Sure.
Please. It's cozy, in sync with the neighborhood. The ranch-style home features a reimagined open layout. That means they knocked a couple walls down. Are you ready, John?
I don't know what you're talking about, but sure.
$1,200 per square foot, $2.7 million for a tiny ranch house in Jackson, Wyoming. And this is not shishi. This is like, you know, really
Does that
basic.
explain the private jets at the airport that we saw lined up yesterday?
Yeah, Kanye waved to me. What's important here is there's more private jets here than there are at Davos. They're coming in. You know what they're getting? Like Florida, there's no state taxes. It's that complicated.
Thanks for the story, though.
No, it's a little color here.
Cozy two
You know, I know, is Chairman Powell coming in on a Gulfstream? You know,
to stay in a cozy two-bed.
Yeah,
Jackson Hole.
We'll have to see.
Can I talk about gas prices, nat gas prices in Europe? Up another 6% today after being up 8.6% yesterday. I've lost track how much we're up this month, but I can tell you, Lisa, it's a lot.
Well, yeah, Lisa, $520 a barrel equivalent.
There are so many different equivalencies that I've looked at. The bottom line is when you see your natural gas prices doubling in the span of 2 months, that changes the discussion for people trying to keep
John, what's it mean for the people of Europe? You live this every day.
How many times have I used this word, brutal? Brutal. And it's the number one issue on the phone with my mum every time we talk. The price of electricity, utility bills. It's going higher, higher, higher. Up next on this program, we'll hear from the Kansas City Fed President Esther George, the host of this get-together, and we'll hear from Mike McKee as well. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight
We think that's the next secular shift.
from businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts, great questions.
Live from Jackson Hole, Wyoming this morning. Good morning, good morning. It is the annual Fed get-together, and the host of that get-together is the Kansas City Fed President, Esther George. She sat down with Bloomberg's Mike McKee and Kathleen Hayes.
If you think about how tight the labor market is, we are operating with an unemployment rate that is below, I think, what most people would consider to be a normal or natural rate of unemployment. So that suggests to me that to get loosening in that labor market, to see some of this tightness come out of the economy, that you may well see more unemployment in the process of this tightening cycle.
Well, you got two camps, one that says you need to keep going no matter what, and another that says you need to be careful because these are real people who lose jobs. So how much unemployment is too much?
Well, I think anytime someone is unemployed that doesn't want to be, you care about that. I think in the long run, which is where I'm focused, you have to have a sustainable economy, and the best path to full employment is going to be conditions of price stability. And so I think for the long run, that's where we have to be focused to bring inflation down so that we can have those conditions.
So what are you looking at when you see the housing market? We saw pending home sales, but they're the weakest again since the beginning or before the pandemic even. Mortgage rates have shot up. We know all kinds of people who backed out of wanting to buy a home because they're expecting prices to fall more. So is that a welcome tightening in financial conditions? Is it a little bit more than the Fed has bargained for?
Well, I think it's been one of the first places we've seen it. So you saw that initial tightening in mortgage rates come very quickly early in the tightening cycle. And that, of course, does affect the economics of someone being able to afford a mortgage, make that payment they need to pay. So in some sense, this isn't surprising to see these numbers come off, to see sales come down. Whether the actual prices, the housing valuation comes down consistent with that, I think we will still have to see, and I suspect that could be to come.
You know, you just mentioned that the funds rate could have to go above 4% to get to the point where you're slowing down the economy and really slowing down demand. John Taylor, author of The Taylor Rule and More, who you know well, just a couple of days ago on Bloomberg Television told me that he thinks the Fed should be aiming for 5% or even more if inflation does not start coming down more rapidly.
Well, I think certainly if we don't see a response in bringing this imbalance between demand and supply to bear on inflation, we will again have to consider where that short-term interest rate is going to have to move.
So you wouldn't rule out something that high?
Well, I wouldn't rule it out. I'm not suggesting that's where we're going. But the other thing, Kathleen, that I think we don't talk enough about is the sizable balance sheet that the Federal Reserve has, and that we will be doing runoff of that balance sheet. And again, understanding how these two things work together, I think is going to be important to see how that runoff works as we go through the year. And that's the other part of this rate increase environment that is important to watch, I think.
What's the danger of recession that you see, and what would you see it in terms of indications that we are slipping into contraction?
So, you know, again, when I go around my region, I don't hear many signs of that from our contacts. What I hear is tight labor market, price pressures, supply constraints going on here. I will tell you, when I look at global growth, though, So we've seen the IMF cut its forecast for global growth. We see the issues in China. We see Europe. And we know that reduction in demand will affect our own growth here, simultaneous with the tightening cycle that the Fed is underway. So how it comes out in balance over time is hard to know. But I think, again, the focus on watching these imbalances resolve themselves are going to have multiple factors that will come to bear on them.
President Biden has now introduced a student loan forgiveness program, $10,000 or $20,000, depending on the program you were in per person, which is going to cost billions of dollars. And a lot of economists are worried this is going to be inflationary. Do you see it working against your goals?
So I haven't looked at this particular decision that came out, but I think always fiscal policy is something we will take in to understand. Is it an impact in the short term? Does it happen over a period of time that makes its particular impact to the economy there? So I don't have a sense of the particular impact here. Again, given the size relative to our economy and what we're looking at in consumption, I'd be hard-pressed to say what I think its impact is right now.
Speaking of your district, speaking of the world economy and what's driving it right now, drought is big. It's across much of the western United States. In Europe now, is it the point yet where it enters into a factor in policy? And is something like drought and what it could do to production, agricultural production, all kinds of things, is it potentially a drag on the economy, which tilts you toward recession potentially? Is it something that boosts inflation because a lot of prices are going to get even higher, particularly for food?
Yeah. So issues that affect our real economy are things that I think we have long taken into account. You think about a region like mine where agriculture is prominent. The idea that weather events, the idea that commodity prices all come to bear on how the economy does, what it contributes to GDP, where the constraints are in that sector. I think these events just are continuation of some of that, and the magnitude of them may change. But I will tell you, for example, in the Kansas City Fed District, drought in the western part of our region does have impact on the yields that are coming off these crops now. It will matter over time. Farmers are used to dealing with that in many respects. Banks that lend to them are used to dealing with that. And I think in that sense, it will have the same impact on our policy that we see across many sectors of the economy.
A very near-term decision. And every Fed bank president, every Fed official gets asked this all the time. And especially you, because you did dissent against the first 75 basis point rate hike. And you just recently said you're going to continue to debate the needed size, 50 or 75, with your Fed colleagues. So again, when you see how well the economy is holding up and how little inflation has come down this far, what is your baseline? Is your baseline 50 and you're going to have to be talked into 75? What's going to tilt the balance for you?
I mean, I supported 75 at the July meeting, and I find it an interesting time when we debate 50 or 75, because who would have thought 50 would have been a more dovish view than 75. I think for me, coming into this September meeting, we're going to be looking again at an inflation report. We're going to be looking at a labor market report, and I think trying to draw some sense of whether we see continuation of things that we've seen over the summer, whether progress looks like it's meaningful in some way. I do look forward to getting back to a sustainable rate path. That was my issue at the June meeting. Again, no disagreement about the direction we are headed, but I think just being mindful of the destination and how quickly we get there at a time when we're reducing the balance sheet.
You've been doing this for a long time. The old adage was, don't fight the Fed. Why do you think the markets are fighting the Fed now and not listening to what you've been saying about how serious you are about taking on inflation?
I don't know what drives the markets, Mike. I probably would not be well positioned to say that. Certainly, it is important for our communications to be clear because we want financial conditions to tighten along with the direction we are moving around policy. So I think it puts a premium on being clear in our communication, of having resolve toward the end game here. And again, the end game is to bring inflation back to our 2% target. And that's challenging in the environment we're in. We're coming off an unprecedented period. The economy, I think, in some respects, is still sorting itself out. We have global factors to take into that. So there's a lot to think about. I'm sure markets are thinking about that even as we proceed with this interest rate increase cycle.
You're retiring at the end of the year. This is your last economic symposium. How do you think economics and the economy and the Fed have changed during your tenure?
Well, a lot has been done. When you think about the great financial crisis, where the introduction of quantitative easing came about, zero interest rate policy, has been an extraordinary time for the economy, for policy to think about how it responds to the economy. Also coming into a time when we have demographic changes, really broader changes around the world. So the world continues to evolve in ways that sometimes look clear to us, sometimes don't. But
well, in this vein of here you are about to end your wonderful tenure at the Kansas City Fed. This last part, I would think, has been one of the very most difficult parts, seeing inflation get out of control the way it has. What's the biggest lesson learned for you for the Federal Reserve after having gotten into this situation and now needing to get out of it?
So, Kathleen, really, I'm going to answer that question by saying this is one of the things I'm looking forward to with the conference that we have this year, is really reassessing how we understood constraints over the last couple of decades, finding ourselves again in a place of high inflation, which we hadn't seen for some 40 years, and really being reminded what are those factors that are important to price stability. We know as our mandate that hasn't changed for a long time, even as the economy has evolved, even as the toolkit may have evolved, but getting back to really thinking about how price stability is achieved, even as the world changes, I think, is going to be an important part of this discussion here at Jackson Hole Symposium.
That was the Kansas City Fed President Esther George sitting down with Michael McKee and Kathleen Hayes. There will be an open position at the Kansas City Fed in the next 12 months. Tom Keene's dropped by to fill out an application form, and Mike McKee's jumped into his seat while TK's gone. Mike, great interview with you and Kathleen. I want to pick up on the very end of that interview when she said financial conditions need to tighten. Do you think this is going to be a theme here for you personally and for this event as they look at where markets have been the last couple of months and ultimately where they want to go?
I think it's something that the markets and the Fed, I asked her about fighting the Fed, but they're agreed on the fact that financial conditions have loosened, and that doesn't help them get to where they're going because the only tool they have is to tighten financial conditions. So it should be that the markets understand that they have to go higher to get there. But there is a division between those who think inflation is the most important thing, and those in the markets who think that maybe recession is coming and we need to react to that in time. George, in June, dissented because she was worried about that long and variable lag for monetary policy hitting, and that you could have policy really start to tighten at the time you go into recession. But she said there isn't evidence yet of that, and so she's still on the inflation fighting side.
I don't expect them to give a state contingent forward guidance this week. I think they're done with that whole activity. So I'm not expecting them to say something like, if unemployment goes back to 4.5%, we'll back away. I think what we'd love to see, though, Mike, is if we're all trying to gauge this, what's the hurdle? How high is the hurdle for them to say, that's enough pain, we need to balance the two things now?
Yeah, well, you heard her say, and I think most of the Fed people are agreed on this, that they don't know that they're anticipating going to close to 4, but if it has to go to 5, if it has to go to 6, then they'll do that. And her argument, which a lot of them make, is that unemployment is so low, below the natural rate of unemployment, that you've got that room to do it without pitching us into recession.
Esther George has had a more dovish tone. This is sort of a different tone, basically acknowledging that there is a certain weakness in the labor market that is necessary to get back to price stability. How much will that be the theme? That they don't want to give anything to markets to give them a chance to rally further?
Well, I think what we've seen from Jay Powell over the course of the last 6 months or so is an acknowledgement that unemployment is going to rise. The only question is how much. And he said 4.1% or so is okay, which is the lower end of what they think the natural rate of unemployment is. But if it goes much higher than that, you get into this political area of the politicians starting to put pressure on you because you put so many people out of work.
Mike McKee, awesome work. Looking forward to catching up with you through the next couple of days. Role reversal between Esther George and Neil Kashkari, right?
Exactly.
Last couple of weeks. What's that about?
Yeah, and going back in the other way. Let's see where they end up this time.
Coming up on China, Enda Curran, our Bloomberg chief. Emerging markets correspondent. Very shortly. This is Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, of the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
To me, this whole argument that they should, hike well beyond 4%, and then sort of that's the only way they're going to be able to rein in inflation doesn't make a lot of sense, because if they do that, then there's a potential that things break. The economy in the U.S. is quite brittle.
I think you'd make a very good Kansas City Fed president. I think you'd be fantastic at it. I think you should fill in that application form and go for it.
Yeah, it was under thought last. After the third martini last night, it was considered.
You started hallucinating about what could be.
We need to get back to square one here, and I thought that President George really nailed it. The things they're trying to do, it's not in the textbooks.
It's not easy.
As Mike McKee said, their tool is to raise rates, and there's no other tool besides a job bonus.
Tom, you've talked about how the political pressure might turn the other way.
Yes.
The political pressure right now is get inflation down, get inflation down. You wonder how long that can hold, Lisa, if unemployment starts to climb, and if we start to see that going into the end of the year.
The weakness that we have not seen yet, when does that create a more duality here of the labor market mandate and the inflation mandate for a Federal Reserve that only has one mandate right now? And I thought it was interesting that Esther George just emphasized the inflation. Price stability is the key to a strong economy, period, full stop.
Will those two sides of that mandate, Tom, be in conflict by the end of the year?
They've been in conflict since McChesney Martin in 1951 when Harry Truman and he tried to figure out how to have an independent Fed, and that's part of the debate of an independent Fed. Let's remember that the former president would be apoplectic, President Trump, over this strong dollar. We're not hearing that from President Biden.
We're not hearing it at all, actually. And at the moment, I would say, actually, perhaps there are some people in Washington who would welcome the dollar strength we're seeing, because to some degree, it's helping. Just put a lid on inflation, some of that imported inflation. That's a luxury. We've said this a few times already this morning, so forgive me for repeating myself, but that's a luxury the UK and the Europeans don't have.
But it shows how much the entire playbook of the past decade, of the past 2 decades, has been turned on its head.
Flipped upside down.
Flipped upside down. So how about President Trump actually liking a strong dollar now versus the weak dollar then? I'm not going to go to the former president. It's more about a complete shift in the zeitgeist.
And of course, we'll have our coverage tomorrow. We're going to extend right through, and you will see the speech of Chairman Powell here on radio and on television as well. This is an historic building, and whether it was built in 1955 or the visit of Lady Bird Johnson here were their first efforts of environment in the 60s, there's the reality of history being made. About 15 feet from Lisa Abramowitz is one of the most historic tables in international relations of America, a place where James Baker signed an agreement with the Soviet Union long ago. Those tensions stay, and they stay in China as well, and the current joins, always giving us good briefs from Hong Kong. And I want you to describe the domestic tension that Beijing faces to jumpstart a 3% growth economy.
So let me bring you up to speed on what happened today, Tom. Basically, the government has rolled out, or planning to roll out, about $150 billion worth of stimulus. Now, this is going to be mostly spent on new infrastructure. It will go through the big policy banks, the government-owned banks taking stakes in these projects, and it will involve the local governments also ramping up their spending. Now, however, the government did say at the same time that they don't want to go overboard with their spending. This is something of a divergence from the West, because the Chinese government and authorities have been very critical of QE. They've been critical of the excess seen in the West when it came to responding to the pandemic. So even though their own economy now is slowing and they are putting more money into the system, into the real economy, they're also saying that they're only going to go so far. They're not going all guns blazing or anything like it yet. And that's why economists today are saying what they are doing really won't be enough. It won't be a game changer to keep things in and around that 3% area. And if I could, just on the exchange rate, by the way, I heard Lisa talking about the dollar. China also seems to be favoring a strong yuan at the moment, because it had been weakening. It had been selling off in recent weeks, but this week the authorities have come in with a stronger fix in the daily fix, hinting that they want a stronger currency too.
I need to rip up the script here. This is really important, folks, what Mr. Curran brings up, and this alludes to Jacob Frankel here at Jackson Hole. Is it a fixed currency, Enda? I mean, is there a delusion here that yuan is floating?
Well, it's obviously a managed currency, Tom. They do allow it to trade within a range, but ultimately the authorities have a lot of say over how far it can go in either direction in that range. Now, recently, the market had been pushing it down. It was weakening against the US dollar, less so against trade-weighted peers, but it had been weakening against the dollar. The thinking was, this is a policy lever for China. Maybe they're going to allow this to happen to help the exporters. But we had a lot of commentary in the state press this week saying it's not a one-way bet, yuan weakness. And no sooner did that commentary appear, only we saw the authorities come in and set that daily fix a little bit stronger against the dollar. So just to your point about the kind of regime shift on currencies, it doesn't appear as though China is in a hurry to adopt or embrace a weaker currency either.
And right now, the PBOC is starting to get a little bit more aware of the pain that we see reflected even in the official data. And the market is not really that enthused. People do not seem to believe that this is going to really generate confidence by consumers and businesses to go out and invest at a time when zero COVID is still really crimping the economy. And frankly, when industries are actually shutting down as a result of the drought and what that does to power supplies in China. What are we looking at if we look at a futility from the central bank, futility from central bank action, as well as policymakers? What does that mean about how much more pain the Chinese economy can have?
So the response so far, Lisa, has been both piecemeal and, as you mentioned, it's not gaining traction. So that's why a lot of people are saying there's going to have to be a big pivot here somewhere. And does the pivot come on COVID zero? Now, obviously, there's been a big public health dividend from that, but clearly it's now dragging on the economy. So do they pivot on that? But the political messaging has been they will not pivot on that. State press this morning again saying you cannot lie flat in the battle against COVID. Well, then you look at real estate. What are they going to do there? This is a part of the economy that they could really jumpstart if they wanted to. Again, it's piecemeal. They are surely putting a floor under things. They are going to make whole those people who bought flats who haven't been finished. But we're not seeing any kind of a massive stimulus on the way that would totally rev up the construction and real estate sector. So a lot of people are asking, where is this turning point going to come for China's economy? It just seems to be barely crawling along into the end of the year, into the Congress. Maybe after Congress we might reach some kind of a turning point. But so far the signals are pretty cautious. And like I said on the stimulus announcement last night, they said they're putting money in, but they're not going to overdraw on it.
Hey, Ender, thank you. Bloomberg's Ender Curran out of Hong Kong. Thank you, buddy, as always. This is the situation in China right now. We've gone over these numbers a few times for you. The forecast for China GDP, 3% if you're Goldman Sachs for this year. If you're Nomura, 2.8%. The forecast for Europe, a lot of people lining up to call it a recession in the Eurozone economy. So for the Federal Reserve, Lisa, how many times have we asked this week? And I think it's an important one for Fed presidents and the chairman alike. How do they navigate this?
Well, how much momentum can the U.S. economy maintain in the face of what's going on overseas? Is this just a corporate profits issue, or does this go further to the core of what's driving growth in the U.S.?
Can I pick up on a theme that you started with in this segment? Just how things have been turned upside down. We've gone from Max Dovish to Max Hawkish. We've gone from let's try and get inflation up to let's try and bring inflation back down. And we've gone from I really want a weaker currency to Jay, can I really have a stronger one? And right now, the Europeans haven't gone one.
It's a toxic brew.
Is that a toxic brew?
Yes,
and that's often a toxic brew.
We brought the road tang, folks.
That is often a toxic brew. From Jackson Hole, Mohamed El Arian, up next.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming through?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Clearly, last year, the Fed was really off its mark.
The Fed needs to unhitch their wagon from headline prices. They can't control that stuff. They can't control food or energy prices.
Globally, inflation is a big concern, so they're going to have to factor that into how they look at the markets in the U.S.
We're seeing wage growth 5% plus, and I think that's really the issue for the Fed.
I think they can bring inflation down to 2.5% or even 3%. The question, though, is can they keep it there?
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
I'm just refusing to go outside until the sun comes up. I won't do this in the dark. So we've got what?
Bear alert.
Another hour?
No, seriously, there's 200 bears in Jellystone and in Grand Teton, 200 total, and Bear 39's got your number.
Live from Jackson Hole, Wyoming. Thank you for that. For our audience worldwide, good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. TK, it's the annual get-together, and once again, it's all about the chairman tomorrow.
I just looked at $22 million, 7 bedrooms in Jackson Hole, 3,200 per square foot, and the comedy of the good Federal Reserve Bank of Kansas City having their event at the richest real estate in the world, in America. John, it's insane how the two Americas here are identified at $3,200 per square foot.
Are you suggesting this Fed might have a role to play with some of these real estate prices?
I think this is important. We can talk to Dr. Larian about this. The partition of this nation coming off the creative finance under crisis 15 years ago, starting right here, 15 years ago, has led to that partition of 3,200 per square foot, 5 bed. I stand corrected. Surveillance correction, 5 bedrooms, 7 baths.
Would you like to read out the description of the home you're looking to buy?
Well, I toured it yesterday. No, I went through it yesterday.
That's what you were doing last night.
Yeah.
After 2 martinis. Anyway, okay. We caught up with Esther George of the Kansas City Fed a little bit earlier this week, just yesterday. We played out some of that sound for you this morning. Here's what she had to say. We need to get rates higher to get demand down. How much pain are they willing to tolerate? It's going to be a big part of this annual get-together of this Federal Reserve.
And what we have seen is they have not come out that dramatically to really say, we need to get inflation under control, full stop, regardless of the cost. That seemed to be where she was leaning. The balance was out, and it was much more price stability is the bedrock of any economic growth and any strong economy. That's change in tone for her, and I think that that's going to be reflected.
Can you reconcile how this market has been priced over the last couple of months or so and the communication they're offering? How many times have you heard Fed pivot? From market participants, I don't ever hear that from Fed officials.
What I want to hear, and Mohamed El-Erian, I'm sure will weigh in on this, does this reflect the lack of credibility that this Federal Reserve has with the market? The market saying, you guys are not understanding the weakness. We don't buy it. We know you're just trying to signal to us, but just wait. Next year, we're going to see that weakness trickle through, and we still, on the margins, believe in a transitory story. How much is that what we're going to hear?
I talked to President George last night over a quiet dinner at the Pioneer Grill, and she's really considering getting a dog in Kansas City, and she's going to name it Pivot.
I actually heard you tell her that.
No.
There was no official comment on whether she was interested in calling that dog Pivot.
I think, well, how do you pivot? And, you know, to get to Dr. Leary here,
8.5% CPI. Think about how ridiculous this conversation is. 8.5% inflation in America.
You're totally correct. And what's great is this next guest that we have, John, owns the thinking behind the game theory of something as silly as pivot.
Let's get to that next guest right now. We're really happy to say that joining us is Mohamed El-Erian of Bloomberg Opinion and Queen's College, Cambridge, a man who, unlike this Fed chairman, called this inflation spiral. Mohamed, let's go straight there. The challenge for this Fed chair at this annual Fed get-together, how big is it?
It's huge, John, and good morning. It's huge because he's speaking to multiple audiences, as you pointed out, but it's also huge because he's got to deal with issues with respect to the past, the present, and the future. He's got to figure out how he's going to address his speech last year that proved so off the mark. He's got to figure out what to signal about current monetary policy. And let's not forget that we have a framework that is not fit for purpose. We have a policy framework fit for a world of deficient aggregate demand, and we are in a world for deficient aggregate supply. So put all this together, the challenge is very big, John.
Mohamed, you're focused on a new word, stickiness, and you've been focused on that for a number of months now. From the incoming information, how sticky do you think that inflation dynamic is? And how much does that tell you about how much work this chairman still has to do?
So I worry that core inflation is going to prove more sticky than the Fed anticipates right now. We have wages are starting to be a driver of higher costs and eventually higher prices. So while headline inflation is going to continue to go down for the next 2 months, core may prove quite sticky, and that's a real problem for them.
For those of you on Bloomberg Radio and Bloomberg Television, you just saw a little bit of light going out. That was one of the grizzly bears standing up and getting in the way of the light here. They're watching here this morning as well. Dr. El-Erian, people forget why you are Dr. El-Erian, and it has to do with the acuity and concision of your game theory. You codified in the modern day the phrase T decision. Let's distill that down to the T decision that Chairman Powell has to make between now and a data-busy September.
And it's an important one, Tom, because right now the Fed is so late that it's looking at two challenges. It's looking at putting the inflation genie back into the bottle, and it's looking at not creating too much damage to economic growth and inequality, something that you have been speaking to all morning. Look, I don't think he has any choice. He's got to put the inflation genie back into the bottle. You know, there's an old saying that macro stability isn't everything, but without it, you have nothing. So they've got to put that inflation genie back into the bottle and do it in a determined and sustainable fashion.
Okay. But this is the politics of it, Dr. El-Erian. If you have a partial differentiation from 8% U.S. inflation, the haves are benefited when you get to 6% or 5%. The have-nots, the great middle class, are still flat on their back. What is your timeline where all of America finally gets inflation back into the bottle?
So it's going to take some time because the Fed has been asleep at the wheel, and that's unfortunate. Tom, what you raise is much bigger. It speaks to the Fed being necessary but not sufficient to address our policy issues. You've got to deal with the inequality aspect. You've got to protect the most vulnerable segments of the population with focused fiscal policy, and you've got to do a lot more on productivity and equal opportunity. So it's a long list, but the Fed has to focus on inflation and has to do it in a more committed fashion than it's done it so far.
So it's been trying to sound, Mohamed, committed, right? I mean, they've basically been saying inflation is their number one issue that they're facing. Why is the market not hearing it?
Two reasons, Lisa. One is the Fed itself. Let's not forget that Chair Powell stated that we were at the neutral rate. The minute the market heard that, it moved, and it moved in a significant fashion, and all the talk about pivot started being amplified. So that's one reason that the communication hasn't been consistent, and that's been a problem for the last year. And the second issue is that the market is looking at the impact on growth, is looking at the potential impact on markets, and as John said earlier today, remembers the fourth quarter of 2018, remembers the Fed blinking, so it believes when push comes to shove, the Fed is going to blink again, that we're going to have a flip-flopping Fed.
Mohammed, what I hear from you is that you don't think this Fed blinks anytime soon.
I don't know, John. I know what they should do, which is they should not blink, but it's been very difficult to call this Fed. This Fed has unfortunately failed at analysis, failed at forecast, failed at communication. So it's very difficult to say what this Fed is going to do. It's easier to say what it should do, but it's much harder to say what it's going to do. And that's why you get this disconnect that you've been talking about between the markets and the Fed.
Easier to find out what you think. So let's go there and wrap up this segment with you on what you think. Larry Summers called that neutral comment analytically indefensible. You said on neutral, and I think you were a little bit more diplomatic about it when we last spoke, you said the zip code for neutral was higher than where we are right now. Mohammed, what is the zip code for neutral, and how on earth do we know with inflation where it is and where rates where they are right now?
So I don't know specifically where it is, and I've been warning against spurious precision. There are so many structural changes going on. We are changing liquidity regimes. I said earlier, we're going from a world of deficient aggregate demand to a world of deficient aggregate supply. That's the world we live in now. No one knows for sure where neutral is. So you've got to try to figure out as you go along the way. And you mustn't attempt this spurious precision, because if you do, the market is going to jump immediately to conclusions, and then you're going to have to undo it. You know, the Fed itself, Fed officials have walked back that comment. It didn't take many days for other Fed officials to come out and say, we're not at neutral.
Mohammed, it's great to catch up with you. I'm pleased to say you're going to be sticking with us for another 15 minutes. Mohammed,
good. I didn't know that.
Mohammed in New York when we're not in New York. Have you noticed that?
Over.
Yeah.
Have you noticed that? Are they going to cut off the line to us?
Yeah, exactly.
I think from Cambridge he's on sabbatical, actually.
He's on sabbatical.
Yeah.
How long for?
He was there for 3 months, so they gave him a 1-year sabbatical.
There we go. It's
like
6:10 local time here in Jackson Hole, and you can probably hear the cafe behind us starting to set up, TK, as the Fed presidents slowly wake up.
This is the research that we do here at Bloomberg Surveillance, and what's so important about this is what has changed here in the last 8 months. After a raging debate of 5 or 6 years, Wyoming has allowed for roadkill. If you see something in the road, you can now legally pull it up.
I'm sorry.
It's 6.
Is that the extent of your research?
5 months ago. This is important. 5 months ago, Wyoming 511 is an app you pick up where you communicate. So this morning here, at the meetings of the Kansas City Fed, we've got elk, bison, and a tourist from New Jersey.
This is the benefit of a 3-anchor program. If one of us doesn't do any real work, the other two can try and pick up the slack. Are you serious?
No, I'm serious. Roadkill. It's a British idea. You could do this outside of London. You could have London roadkill.
Krishna Mamani is coming up a little bit later of Lafayette College. He's not going to be talking about roadkill, and neither is Mohammed Al-Arian.
The squirrel. Yeah, last night. I had a squirrel last night on the way up.
Stop it. Stop it. From Jackson Hole. You're done.
This
You're
is
done.
true.
You're so done. This is Bloomberg.
We're going to talk.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Kansas City Fed President Esther George says the central bank has to get interest rates higher in order to bring down inflation. She spoke to Bloomberg TV at the Jackson Hole. We'll see which tweet.
We have more room to go. That we would bring those rates down quickly, and I've seen that in some of the forecasts. Seems a bit remarkable to me. I think we will have to hold
over 4%.
It could be well over. It could be over 4%. I don't think that's out of the question. But again, you won't know that, I think, until you begin to watch the data signs.
George says it's important that the Fed is clear about where it is headed. Citigroup is joining those companies that have closed operations in Russia since the invasion of Ukraine. Citi will wind down its Russian consumer and commercial banking units after a sale stalled. The company will incur $170 million on costs tied to the exit. In Uvalde, Texas, the school board has fired the school police chief following that mass shooting in which 19 fourth graders and 2 teachers died. An investigation described Pete Arredondo as the commander responsible for police response. Law enforcement waited outside the school for more than an hour whilst the gunman was inside. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close, weekdays on Bloomberg. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's very important that we are clear in our communication about the destination we're headed. And I think that destination is important, which is we have to get interest rates higher to slow down demand and bring inflation back to our target.
That was Esther George, the Kansas City Fed president, live from Jackson Hole this morning. Good morning to you all. Alongside Lisa Abramowitz and Tom Keene, I'm Jonathan Ferro. Futures just about positive, up 0.6% on the S&P 500 TK, as we gear up for a big couple of days ahead at Jackson Hole.
Big couple of days ahead again under that speech tomorrow, and we're really thinking about the theory and the underpinnings of our monetary system. But that system is not just the United States. It's a global system. And now with us, we continue with Mohamed El-Erian, writing for Bloomberg Opinion, and far more with an international economic and financial perspective for his University of Cambridge. Dr. El-Erian, I want to go to the international tone here. Central banker of the world. And the singular feature I have is the focus is on Plaza Accord-like partners when there is EM. Forget about idiosyncratic Turkey out over 18 lira. What will be the shock of Powell action to a more fragile emerging market in third world economies?
It's a high-risk situation, Tom. You have higher rates, so more uncertain market conditions. You have global economic growth slowing much faster than most people expected, and you have a stronger dollar. Historically, that has not been a favorable mix for emerging economies.
So right now, how much does this bleed back to the U.S. economy? How do you bleed through the pain that you're seeing in Europe, in China, into slowing U.S. growth and entering a recession?
You know, Lisa, the quick and easy is to say that everybody has an inflation problem, everybody has a growth problem. And that's true. But go further, we have massive dispersion. Growth, the U.S. is in a much better place than most other countries. Central bank policy, if we think that the Fed faces tough challenges, look at the ECB. Not only do they have high inflation, they have a much more fragile economy, and they have the risk of fragmentation. So I think the theme going forward is going to have a strong element of dispersion come into it. And that makes markets have to spend a lot more time thinking about relative values and not just the overall beta, if you like.
When you take a look at the framework, policymakers are starting to think more about a structural inflation that will last a much longer time due to deglobalization and due to sort of structurally higher commodity costs. The market is not buying it. They are still betting on some sort of return to what we've experienced over the past few decades. We know that, Mohamed, you err on the structural side. You say that's probably where we're going. What will it take for the markets to wake up to that reality, and how violent is that pivot?
It's going to take time. You know, I'm a buyer of the notion that we are changing macro regimes, as I said earlier, from deficient aggregate demand to deficient aggregate supply. You pointed out to the Wall Street Journal article earlier that listed 3 reasons why supply is going to be a challenge in the next few years: globalization, deglobalization, etc. So we are in a different regime. I think the economists recognize this. I think the Fed officials semi-recognize this. Markets are still in a cyclical mindset, and it's the mindset that has served them well. So it's going to take some time, and it's going to take persistence on the part of central banks to try and convince markets that they have to think structurally and not just cyclically.
So, Mohamed, with that in mind, what are the characteristics of this new market regime? What do you think the defining characteristics are and will be?
I think resilience is going to be the key issue, John. I think you've got to have resilient names in your portfolios, whether it's in credit, whether it's in equities. And resilience means balance sheet, means management teams. Resilience is going to be the most important element to help you navigate this world.
Can we talk about the resilience of Europe and finish there? We touched on that at the start of this segment. You talked about the difficulty of the ECB. European gas prices are up by 6.5% again today, Mohamed. I still don't think we fully realise how tough things could be in Europe later this year. Do you sense the same thing from the people you speak to? And can you frame how bad you think this is going to be later this year?
It's going to be hard. It's going to be a cost of living crisis. You see it already in the UK, and you see the reaction in the UK much earlier than you're seeing it in continental Europe. And on top of that, there's going to be massive demand destruction going on. So Europe is looking at a tough 6 to 9 months. I, like some others that have been on your show, don't see how Europe escapes recession. I hate saying that, but the outlook is one of a recessionary economy, and let's hope it's shallow and short.
Mohammed, Agustin Carstens of Mexico, now general manager of the Bank of International Settlements, is published today in the FT with Chris Giles. It's an extremely important piece about our behavior, our individual game theory with higher inflation. What is the when where we begin to embed high inflation behavior? Are we there now, or does it wait for next year?
So it depends who we are. If you are the striking ports workers in the UK or underground workers, you're there. You're already there. Your inflationary expectations have changed. You want to protect your standard of living. It's only a matter of time until they seek not only to protect against past erosion in purchasing power, but also future erosion in purchasing power. So you're there. In the US, you're not there yet. But slowly you're going to get there. And what we're going to find, Tom, and I know you know that in terms of game theory, is that initial conditions vary tremendously. Some workers and some companies are going to be able to protect their margins, to protect their purchasing powers. Others will not.
Mohammed, wonderful to catch up with you. You're getting comfortable in Tom's seat over there.
I am. I love the microphone. It's a bit cold, though, I must say. It's colder here than it is where you are.
There you go, Mohammed Al-Arian out of New York today. Mohammed, thank you. Just absolutely brilliant, as you always are. Mohammed, with us over the last 30 minutes or so. TK, some difficult issues that we'll stay on top of.
This is what it's about. Howard Davies 10 days ago in The Guardian, and what we just saw in the FT with Agustin Carstens. And this is an elite, unique elite feature of Americans. We think we're different. 8% inflation won't become embedded. Baloney.
Elisa, essentially, that's the theme you were really getting at with Mohammed moments ago.
Well, and this is partly because all of what we saw in the 1990s, some people are saying it's going into reverse. The whole idea of finding cheaper labor elsewhere and then importing the disinflation from that. The whole idea of commodity prices being plentiful. People saying that because there hasn't been an investment in a lot of these commodity complexes and the real stuff that we use, it is going to be more expensive for a longer period of time.
I remember something Joe Weisenthal said in the last couple of years, and it stuck with me because I think it's so important. Basically alluded to the idea that the real bubble in the last 10 years was in the labour market. It was cheap labour. And that's burst, and now all these companies have got to try and adjust to that. That's something to think about.
Well, especially because we're seeing productivity go down, wages go up, and we're getting the same thing for it. And that's been a real problem for the Federal Reserve. How do they then reshape what their narrative is?
We should bring Joe Weisenthal here next year with Tracy. Joe can bring his guitar and his band, and they can set up in the bar and
they could do an episode of Odd Lots.
Say Flying Burrito Brothers
downstairs.
And all that.
Very cool. Jay Bryson of Wells Fargo coming right up. This is Bloomberg.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
we've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. And it's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Live from Jackson Hole, Wyoming this morning. Good morning to you. The annual Fed get-together with Chairman Powell addressing the market, the world and this economy tomorrow morning at 8 local, 10 a.m. Eastern time. We've got some economic data coming out very shortly. Let's touch base with Mike McKee for a little bit more. Hey, Mike.
Good morning, John. We're waiting for the numbers to cross right now. I thought you were sending me down here to do a weather report, and I can tell you the rain just started to let up. So maybe you guys can come down and join me here in a few moments. Jobless claims coming out this morning, and I'm losing my connection here, but I'll get the numbers for you in just a second here. Initial jobless claims coming out for last week, and it is kind of crazy because the elements are conspiring against us here. John, if you have the number in front of you, you can go ahead and give that because
Mike, I don't know why we made you do this in the pouring rain outside in Jackson Hole. Mike, forgive me for that. 243K. Is that the theme tune for this market check and this data check? Okay. 243K is where claims come in. So that's a drop from the previous number of 250. The estimate was 252. That's a better number. It's a better number on jobless claims at 243. Personal consumption leads are in at 1.5% for the second quarter. This is the extra read we're getting here. The GDP price index at 8.9%.
That's what I'm putting in on.
Core PCE quarter on quarter at 4.4%.
But to me, the fact that the price index for the second read of second quarter GDP was revised upward tells you something about where the price pressure is. To me, all of a sudden that starts to raise a question about where we end the year. What happens if we end the year at 8% CPI? What does that do for Fed policy?
Annualized GDP quarter on quarter negative 0.6%. The estimate negative 0.7%. Some of the data points. Mike McKee's still with us. So, Mike, since we just got you drenched in the pouring rain to look at that economic data, I hope you heard what I just said and you can respond to it.
Well, I think at this point the issue has been what is the economy actually doing because of this whole question about two consecutive quarters of contraction. So we have a way to rethink about it. Now, the big issue is going to be going into the third quarter. What do we see? So far, the consensus seems to be we're at about 1.3% GDP growth, which would be a rebound. You got people all over the place, though. You still have some economists saying that we could see another contraction, and you got a guy like Ian Shepherdson at Pantheon who says we could see 5% growth in the third quarter. We're going to need to see a bit of a change before we get to that. But that's going to be key. And the fact that jobless claims are falling a little bit, that's not bad. I mean, it still suggests some strength in the labor market, which the Fed is counting on to be able to raise rates.
Mike, we'll take that. It's better news. Mike McKee, thank you, sir. Outside in the pouring rain. Lisa, any price action off the back of that?
Not much. I mean, it's pretty muted, but you are seeing two-year yields lift just a touch. And really, to Mike's point, the fact that you're not seeing the weakness in the labor market and that you're seeing price pressures that are revised upward in the backwards look at GDP shows the urgency for the Fed to move. So that's why we're seeing that front end continue to hang in there and even rise higher.
TK, we'll take some better news, won't we? 243. We'll take that.
Yeah, we'll take yes, I think it's important, but it's one data point in high-frequency data, and we have to remember everyone here is fixated on monthly and indeed quarterly data, and the high-frequency data for Fed officials, I think, gets in the way.
I'm looking forward to the ISM in a couple of weeks' time.
Yeah, you taught me this. I was not a big fan.
The PMI was dreadful. And we've kind of shaken it off because, and excuse me, S&P Global, because this is not a dig. I think that market participants have shaken it off because it's S&P Global, and they prefer here in the United States to look at the ISM.
Well, and it hasn't been as reliable. It hasn't been as correlated with the official ISM as other indicators have been. That said, the peripheral read is that you are seeing a material slowdown, and it's not just the manufacturing. It's also in the services. That was what really struck me, and you're seeing that in the earnings as well.
Will it be confirmed by the ISM, Tom, in the next couple of weeks? And then we've got another payrolls report, we've got another CPI report before we even begin to really think about September 21 with a full set of data in front of us.
Let's meld the data in as we go to September here, and this, of course, off what we've seen, off what we see, I should say, with the speech tomorrow. Jay Bryson joins us. He's with Wells Fargo. He's chief economist and with an international carriage there, but of a company, a bank with acute micro-analysis of the American economy. Jay, dovetail your international view with your domestic view right now. How close are we to recession?
Well, right now, Tom, I think that we're not in a recession right now. I mean, the big indicator I would look at is what you folks have just been talking about. That's the labor market. It doesn't seem to be falling apart, certainly at this point. But I think, later this year, early next year, that's when we think you're going to start to see a modest recession. It's, inflation remains high. What we have seen is real disposable income has trended down. That's another way to say that is purchasing power. And credit card debt is up. Savings rate is down, and we think eventually consumers are going to hit the wall here, and they're going to start to retrench, and that puts us into let's call it a modest recession beginning of next year.
Jay, I've got to go to the franchise, which is Wells Fargo Economics, and of course that dovetails with your housing expertise. Give us an update on housing inflation and rental inflation in America.
Yeah, so Tom, so the way that enters into the GDP numbers, or the CPI numbers, I should say, is it comes in with quite a long lag. And I mean, what we are seeing is we are seeing some softening in house prices. We are starting to see some softening a little bit in terms of rental prices as well. But that's going to remain coming in with a long, long lag. And so that's one of the reasons why we continue to believe that, the core PCE deflator, or the core CPI index, the year-over-year rates are going to remain relatively elevated. And so, Lisa was talking about the core PCE deflator earlier. We think at the end of this year, you're still looking at a year-over-year rate of 4.5%.
So what does that mean for next year? And this is, I think, where the market would disagree with you, or disagree with some, and say, well, it's going to then come down really quickly, that the year-over-year comparison effects are going to take effect, and you're going to see a real deceleration in inflation. Do you agree, or are you looking at something much closer to the Jan Hatzius stickier inflation that the Fed could hold rates higher for longer for?
Well, so first of all, we do believe the core PCE inflation rate is going to come down next year, but that's predicated on our view of a recession. Right? You know, once you get a recession, you start to get softness in prices. If we don't have a recession, if consumers continue to go out there and spend, we don't have the recession, then we don't think the core PCE inflation comes down as fast as we generally think. And also, in terms of the Fed, you know, generally when you see a recession, at least in history, they start to cut pretty quickly. We think they're going to hold the Fed funds rate constant at 4.25%, or through the middle part of next year, just to make sure that inflation is coming back towards their 2% target. So I don't think the Fed comes running to the rescue as soon as we start to see the economy tipping over into recession.
And they keep saying they're data dependent, and we keep asking what data are they looking at. But I want to ask you about the messiness of that data, because last year we got labor market data that really underestimated just how much strength there was, how much demand for labor. What's your view on what we're getting wrong now? Which data is distorted that we're going to look back and say, if only we had gotten a little bit clearer picture?
Well, Liz, I think the thing that we may be getting wrong right now may be the labor market. I mean, you know, so we're getting mixed signals there. You know, if you look at the ISM numbers that you folks were talking about, you know, just recently, we've seen some real softness over the last few months in terms of the ISM sort of numbers. You know, the birth-death model, you know, which is a technical sort of thing, that may be pushing up the reported non-farm payroll numbers right now. So I think maybe we're getting some of the labor market data wrong. I'm sure the people at the Fed are crunching through all those numbers right now, but that would be the thing I think I would really look at.
Jay, you're a student of history, and I want to go to a marvelous effort by the FT today and their Colby Smith on the 40, 50-year history of the Fed. Has there been any time in the span of the half century, or in this Fed right now, where they're really addressing the Americans outside the financial elite and outside the financial system? Is it just talk, or are they actually doing something new in 2022?
Well, so let's go back to 2019, Tom, when they first started to take a more broader view of the labor market, you know, different ethnic groups and things like that. So that certainly is true. I mean, and I think what they are doing now is they're looking more than outside the financial elite. I mean, we all know that inflation affects everybody in the economy. It arguably affects lower income Americans more than it does higher income sort of Americans. So, you know, I do believe they are taking a very, very broad, expansive view just outside of the financial elite. You know, they're focused on inflation right now. They seem to have committed to want to bring that inflation rate down, and if it does, that will bring some financial relief to lower classes of Americans.
Jay Bryson of Wells Fargo. Jay, thank you, sir. Looking ahead to a lot of economic data over the next few weeks as we anticipate a speech from Chair Powell on Friday, tomorrow, and then a big decision from the Federal Reserve on September 21. Do you want a sneak peek of payrolls on September 2nd? Here's the estimates so far, 295K.
I did not know that.
295.
Thank you. That's like
all the estimates aren't in yet, as you know, but 295 is the median estimate right now, Lisa.
Yeah, but we keep hearing how wrong people are getting the labor market. And we just heard Jay Bryson there say, perhaps when we look back, that's going to be the one area that we're still getting wrong. And when you just anecdotally go around, how many hiring signs do you see? I mean, even the Kansas City Fed, but I mean, beyond
this
that.
is the bull case.
TK's going.
This is the bull case.
Exactly. But really, everywhere, it's like we want to hire people.
This is the bull case, and what's so important, John and I were looking here while Dr. Bryson was talking at the Irish Times, where there's a surging Irish employment, just as one anecdote as well. And you see it with claims. And did you say the number again, John? I
295.
295.
295 is the jobs number for a couple of weeks' time. You're looking at claims
10
in and
Jackson
around
holes ago,
250.
150 was normal, and we're popping 295. It's a terrible economy.
Claims right now 243.
It's terrible.
Just to clean that out.
It's terrible.
Have you looked outside? Are we going outside?
It's gloomy.
Is this a game time decision? We're going to figure this out.
Whether we go
People outside, optimistic people inside.
All right, I think we're heading outside.
You know what really pierced that bearish debate? It's that payrolls number north of 500.
Yeah.
That just blew it up.
Yeah.
Krishna Ramani of Lafayette College is going to be with us to guide you into the opening bell, alongside Megan Green of the Kroll Institute and Savita Subramanian of Bank of America as well. You looking forward to that?
Yeah, I am looking forward to a huge social response to President George naming your new dog Pivot. Huge response.
Hey, can you just confirm that that's not true?
No, it's true. No, she told me.
We'll confirm that it's not
Live
true.
from Jackson Hole, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden's plan to forgive a portion of student loans held by tens of millions of people will ripple through the economy, but no factor will be more closely watched than inflation. Bloomberg Economics sees the potential to add as much as 0.2 of a percentage point to the inflation rate next year. That comes at a time when inflation is already at a 4-decade high. UBS says the euro area has already entered a shallow recession triggered by surging energy prices. Economists at the Swiss bank predict the 19-nation economy will shrink by 0.1% in the third quarter and 0.2% in the fourth. Power prices set records today in both Germany and France. And for the first time in a month, global monkeypox cases have declined, according to the World Health Organization. New cases around the world fell 21% in the week that ended Sunday. Dwindling caseloads in Europe offset a continued spike in the Americas. There's still growing concerns about a supply crunch for vaccines. And China is taking steps to support the yuan after it hit a 2-year low against the dollar. The People's Bank of China set its yuan reference rate at a stronger than expected level. That's seen as a signal the central bank wants to slow the pace of the currency's depreciation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
I know what they should do, which is they should not blink. But it's been very difficult to call this Fed. This Fed has unfortunately failed at analysis, failed at forecast, failed at communication. So it's very difficult to say what this Fed is going to do. It's easy to say what it should do, and that's why you get this disconnect that you've been talking about between the markets and the Fed.
Mohammed Al-Arian there of Queens College, Cambridge, visiting our New York studios as we visit Wyoming. It is the meetings of the Kansas City Fed. We welcome all of you on Bloomberg Radio, Bloomberg Television. Some years more quiet, more academic. That is not the case this fractured 2022, the chairman's speech tomorrow, and as well the discussions happening right now this Thursday as the sun comes up across the wonderful Tetons. What we're going to do is drive forward the conversation for you. We're going to stay with you in the next hour. Tomorrow we'll go even further on with a live broadcast, first time of the Fed chairman from this Kansas City Fed. But right now we take what we heard from Mohammed Al-Arian and synthesize it into Bank of America economics and foreign exchange strategy. We do that with Thanos Vanvakidis, Global Head of G10 FX Strategy at the bank. Thanos, thank you so much for joining us and briefing us on strong dollar. The zeitgeist is at some point the dollar moves the other way. When do we see dollar weakness? What are the conditions that will allow for a dollar weak?
It's quite simple, honestly. The dollar has strengthened so much because of high inflation, particularly in the US, and the hawkish Fed. So we need the Fed to start being more concerned about growth than about inflation for the dollar to start weakening. Now, I wouldn't necessarily say that the dollar will get even stronger because it's at a 20-year high, but I would expect it to remain strong because I think we are still far from a situation in which the Fed will feel comfortable having inflation under control and start being concerned about growth.
Thanos, to work off of Alan Ruskin at Deutsche Bank, who joined us a few hours ago here to begin our coverage, Alan Ruskin is looking at flows. Let's take Switzerland, which is, as we know, always overwhelmed by money coming in and ever stronger Swiss franc. Is America being overwhelmed by flows coming in, which is supporting the dollar, harming the degrees of freedom that Chairman Powell has?
Not necessarily. We do see investors buying the dollar, but nowhere as much as one would have expected given the very strong dollar rally. Usually at these levels of the dollar, we have expected a market that will be long and stretched on the dollar. That's not the case. Actually, before this dollar rally started, the market was short the dollar, so these positions got squeezed. And maybe now some indicators suggest a slightly long dollar position. But we have not seen the flows that one would have started being concerned that the position is a constraint for the dollar and you can get a positioning squeeze. Definitely, however, if you get a relaxing of financial conditions because of a strong rally in risk sentiment, this does make the job of the Fed more difficult.
One of the partitions we see, Thanos, is a present president of the United States who has been very quiet on dollar dynamics. The previous president was very strident about the harmful effects of strong dollar. Can Bank of America document that American business is harmed by a strong dollar?
Not necessarily. Although the dollar is strong, it is fully consistent with fundamentals. It has to do with the fact that the U.S. economy has recovered from the pandemic much stronger than the rest of the world, and the U.S. economy has been overheating. The labor market is extremely tight. So it is hard to argue that the dollar has overshot. It is more like the economy has been doing very well, too well actually, and the dollar has appreciated, rather than the strong dollar that is hurting the economy. So from this point of view, the strong dollar is not really a concern at this point. The concern is inflation.
Thanos, very quickly here, if I want to be opportunistic into Q3, what is a trade you recommend where I can make a number of big figure points?
I would say keep buying the dollar dips. I wouldn't necessarily say to buy the dollar at this level, but whenever you get the opportunity and you get the dollar dip, buy it, because I do believe that for the rest of the year, the dollar will remain strong.
Thanos, thank you so much. Thanos Vanvakidis of Bank of America, of course, there on the depth of the system, what the dollar means as well. Let me do a data check here and bring in Jonathan Farrow and Lisa Abramowitz. It's very important to do the data here with the sun rising across Jackson Lake. And the data check is that we've seen 3 elk this morning. We think a bear in the distance, and far more importantly, the majesty of 4 eagles flying from the south up to Jellystone Park earlier on. So joining us from outdoors, away from the roadkill, John Farrow.
Hey, TK, the first thing someone said to me about 2 minutes ago was, is TK too scared of the rain? Is he staying indoors and missing the next hour of programming? I'm told you're coming down here, Tom. And as we go towards that opening bell, we need to really set up what markets are preoccupied with going into Chairman Powell. Lisa, after the rally we've had over the last couple of months, excluded what's happened in the last couple of weeks, we've all been asking the same question, whether what we've seen is an unwarranted easing of financial conditions.
So how does the Fed push back against that at a time when they've tried to, but not with the conviction, perhaps, that people need to hear? And Mohamed El-Erian was brilliant on this. Their message has been inconsistent. So what will it take for the markets to hear the message they want to be sending right now?
And TK, you've said it a million times. CPI right now at 8.5%. It's not a conversation that the officials here are having.
And what's so important here, and a topic for Jason Furman tomorrow, is the social partition of a disinflation. The haves clicking in with benefit at 6, 5, even 4%. The have-nots crushed until we get down to a certain level. John, what is that level, and will Jerome Powell define tomorrow a new non-2% level?
Elisa, you know better than most. For economists, it's good versus bad. For market participants, it's better or worse. And that's what we need to have a conversation about as well. We all know that things in China aren't great. We know that things in Europe are pretty ugly right now. And we know in the United States we're going to have some difficulties later this year. Is that better or worse relative to what we expected a couple of months ago?
And I'll take it a step further. Is the better than expected in the U.S., meaning that the Fed has to be harsher than expected when it comes to trying to penalize and remove some of that froth?
Do they serve hot drinks out here?
Well, so over here, we hear the rain puddles being pushed out from around us, and in there we hear the clatter of the cafe.
The TK enjoying his latte. You know,
exactly, the warm latte.
Are we doing hot drinks out here?
I don't think so.
Mike McKee's here with a cowboy hat looking around.
No.
Not with hot drinks.
Not serving any hot drinks
No.
at all.
Okay.
We can get on that.
Krishna Mamani is going to be joining us from Lafayette College in about 5 minutes' time. We'll hear from Megan Green, and we'll hear from Savita Subramaniam around the opening bell as well. From Jackson Hole, Wyoming this morning, good morning.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close, weekdays on Bloomberg. This is an extended edition of Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from Jackson Hole, Wyoming this morning. Good morning for our audience worldwide. The countdown to the Open starts right now with about 30 minutes until the Open in Bao Bramo. And the main event, you know the main event, don't you?
We're here.
It's Chairman Powell tomorrow.
Clearly, and how much is he going to signal a pushback to markets that have gotten carried away with this idea of a pause or some sort of shift from the hawkishness that we've heard over the past few months?
Has TK made it?
He's
I've got a sighting
over there. I see a sighting.
It's like sighting a grizzly. TK's down here,
elk.
ready to go. An elk.
The grizzlies don't really
Some
like
of you
the rain.
can't hear us. Yeah. Let's begin with a big issue. Kicking off, Jackson Hole.
Really very much in anticipation of what we're going to hear from Jackson Hole.
It's a momentous time in the economy.
There is this risk of more hawkish rhetoric.
I worry that at Jackson Hole, Powell will state the obvious.
They really haven't won the inflation battle yet.
Their battle is against inflation. It may bring recession.
Jackson Hole disappoints.
Risk assets are still quite at risk for a hard landing.
You could get another one of those 10% sell-offs.
Further downside risk.
Recession. They're going to have to come in on Friday and take the opportunity really to reset investor expectations.
All eyes right now are going to be on Jay Powell.
Joining us now to kick things off is Krishna Mamani of Lafayette College. Krishna, let's start right here. Are expectations a little bit too high from some market participants on what we should expect, can expect from the chairman tomorrow?
Well, so if you think about it from Chair Powell's perspective, what is it that he can say that would be very different from what he has already said 15 times over? I think in a place where we are waiting for new data to really discern which way the Fed is going to go, we are trying to make stuff up at the moment. I don't expect anything significant coming out of the Jackson Hole. He may say the same things, and the market may interpret it as more hawkish because that's the way the market is positioned at the moment.
But Krishna, you're the perfect person to join us right now because you're not taking a short-term view or even a medium-term view. You have to take a long-term view with allocations in a pension, with an endowment, and how much you're looking at a changed regime that the markets have not yet woken up to, akin to Mohamed El-Erian, looking at a more protracted, embedded inflation that forced the Fed's hand and forced the Fed's rate up higher for longer.
Well, no, that's for long-term investors. That's really the key point. The question is, are we going to get into an inflationary regime that is dramatically, and the key word here is dramatically different than what has been the case for a while. So if we are talking about inflation being not at, let's say, not at 1.5% where we have been, and 2.5% for long-term investors, does that change the outlook dramatically? I guess the point I'm trying to make is right now it looks really scary. But one can debate whether inflation is going to go up or not. But the magnitude of that uptrend in inflation is far more important than whether it is going to go up or not. And our belief remains that over time, things will start calming down once we come out of the current inflationary episode. The inflation may be higher, but the drivers are not there for it to be meaningfully higher.
Okay, so Krishna, you're taking the other side of that and going back to the old playbook eventually. How much do you look to some of the academic research that's going to be presented at this conference or some of the indicators that the Fed officials are honing in on to potentially change that view?
Well, so, it would be interesting to hear what sort of data that they are looking at to drive policy. But I don't think I'm expecting to hear anything dramatic in terms of new research that would suggest that the inflation regime has changed so much that investors have to dramatically change their outlook with respect to where the returns are going to come from. For endowments, for pension plans, people who are counting on their portfolios to provide significant amount of returns, I think the outlook is still very much for equities over the next 5, 10, 20 years to provide the bulk of your returns, and that's how we will be positioned.
Mike McKee alongside us this morning. And Mike, great to have you with us. I want to begin with the conversation you had with Esther George of the Kansas City Fed and proving that central bankers can just speak quite clearly sometimes. We need to get rates up and demand down. It's that simple.
Yeah, the Fed's only tool is to raise interest rates to get demand down. They can't do anything about the supply side. I think Christian nailed it. There isn't going to be much new from Jay Powell because they've said all along they're committed to fighting inflation. It's just that what's happened is we're getting such conflicting signals about the economy that it feeds the narrative we could be going into a recession or everything could be fine. This morning, we got some data that just makes their job more complicated because GDP, the first revision of it shows that we were down 0.6%, which is an improvement from 0.9, but gross domestic income reported for the first time today rose 0.4. Now, those should be the same thing because one person's sale is another person's buy, but they are going in different directions. So which one is telling the true story of the economy?
Well, inconsistent data, and also, if Mohamed El-Erian is correct, inconsistent Fed messaging, right? And that's been part of the problem and the lack of credibility of their saying, look, we've got to be hawkish. We have one mandate, very clear, as John was saying. So do you think that there has been a real shifting under their belt, under their feet in terms of their approach, and how do they regain that belief, that credibility?
Well, the big shift was when they went away from forward guidance and said, we're going to be meeting by meeting, data driven, because they really have to be at this point because all the data look backwards. And so they're trying to divine what's going to happen. They can't tell you, like they did before, what's going to happen. And that's a real problem for them. Now, I don't think they're as divided as people think because 50 basis points and 75 basis points are both big moves. And until this year, there'd only been 3 of those in the last 50 years of each. So the idea that you're debating 50 and 75.
You're laughing. You're laughing because they didn't
Why
really
am I laughing?
Because
Why
you didn't. Because you didn't. They didn't get rid of forward guidance.
You're a mind reader.
Is that not what
That's
you're
exactly where I was going to
go. Okay.
How did they address the big division in this market right now between the market and Federal Reserve officials, which is the Federal Reserve is talking about tightening more. and market participants are pricing in rate cuts. How do you address that without offering a form of forward guidance?
Well, I think they are offering a form of forward guidance to the point that they say we are going to raise rates until we see inflation coming down. But how much and when, that's the part that they have now taken out of their guidance. And the problem is nobody really knows. Markets are making a bet, but market bets change all the time. And we were just talking about this last night. The idea of what the Fed is going to do in September 21st, the markets are priced exactly between 50 and 75 because they don't know what the jobs report is going to say in the CPI report. They're ready to go either way. I don't think Powell changes things so much as the way the economy develops.
It's about the incoming information. So, Krishna, let's talk about the incoming information. Do you think the two sides of this mandate will be more in conflict as we approach year end?
Well, I think so. I think the economy, U.S. economy in general, is slowing down and slowing down quite rapidly. And in that sort of a context, the Fed has to decide which is a bigger priority at the moment, especially in light of the fact that forward expectations or market expectations with respect to inflation really has been re-anchored. So that's the context that they're dealing with in an environment where the current outlook for inflation is still pretty high and the economy is slowing down. There are trade-offs to be made. And one can make a good case that the trade-off they'll make is, well, they will err on the side of being more conservative and stick with the policy a lot longer than what the market is expecting. And the market will adjust accordingly. I think Mike McKee made the critical point. It's not that the Fed is being inconsistent or they're saying different things. They have been saying the same thing. That is, inflation is their priority. They will continue to focus on it until it comes down. The real question is, what would the data show up over the next few quarters, and would that data change their opinion? It's really not about what they're saying.
Well, except that there is a slight problem here, which is the transmission mechanism for them is in financial conditions. And I think about what Stephen Major over at HSBC says. He has to predict how other people are going to respond to data and then what that's going to do to the longer-term ramifications and longer-term action. How much does an ongoing rally in equities actually cause the Fed to go more aggressively and signal more vociferously that they are going to crimp down on inflation in a much more hard-handed way?
That's a very good point. The one issue that I would take is this market obsession with respect to financial conditions based on equities is somewhat misplaced. From a growth perspective, especially for an economy like the U.S., what matters more is really the credit markets and credit creation for the private sector. And clearly that has certainly loosened up, and that's something that the Fed has to worry about. But the question for the Fed really is, has it loosened up too much relative to what the forward-looking data is looking like? And I think that's the question the market has to debate over the rest of the year. Again, as I said before, there's a case to be made that we have not seen the bottom, and we may retest that June low because things are coming back quickly and inflation is not really slowing down as fast as we would like. But that is a debate that is going to continue for the rest of the year.
Krishna, can I squeeze one in on high yield credit? I caught up with your friend Bob Michael over at JP Morgan Asset Management yesterday on this program, right about 24 hours ago. He was bullish, more constructive on high yield in the last couple of months when spreads had gapped out to about 580 basis points. Where they are right now, not really interested. He thinks next year we can get back out maybe towards the kind of levels of 650 towards 700. How are you thinking about high yield credit, Krishna, into next year?
Well, so I'm glad Bob has changed his position a little bit, because that's not what he was saying the last time I was with him on this very show. The point is, if the data is going to turn down and turn down hard, we can make a case that we have probably seen the bottom. I don't think that is the case. I think there's still a great deal of strength in the underlying economy, and the inflationary pressures remain in place. That sort of keeps the Fed in the current path. And there is an equal likelihood that they may get to, it's not just as much about terminal rate as to how long do they stay at that terminal rate. And I think there's a case to be made that may be a little bit more tenuous than what the high yield market is expecting right now.
Couldn't agree more. Krishna, thank you, sir. Krishna Mamani of Lafayette College. That's what Jan Hatsius was saying.
Yeah, exactly.
3.5, you get there, but maybe you hold it for how long? 2 years?
For 2 years.
2 years.
And how much does that really change where the market is right now? Because they're looking for the opposite.
Mike McKee, can we talk about QT just briefly? When we have all these Fed presidents lined up in this seat tomorrow, in about 60 seconds, tell us how important this QT discussion has to be.
It's going to be less important to the Fed than it is to the markets, because nobody knows at the Fed. You ask them what impact it's going to have on rates, and they say there's no way to know. And so they're going to let it play out and then react to that. If they tighten. Well, I mean, if it starts to tighten credit too much, then they can back off on the rate side, or vice versa. But they can't go into it knowing what's going to happen, and they can't tell you what's going to happen, because this is only the second time we've done it.
Can they tell us anything about interest rates without a deep understanding of what a $1 trillion reduction in the balance sheet is going to do to financial conditions?
Uncharted territory, and that's what the whole theme of this meeting is all about.
Mike McKee, looking forward to the coverage that you'll be leading with Kathleen Hayes through the next 24 hours or so. I can tell you, TK sighting out of the corner of my eye. He's loitering.
Yeah.
I'm not sure what's going on here. Megan Green's going to be joining us shortly as well from the Kroll Institute. Looking forward to that. Live from Jackson Hole, Wyoming this morning.
He's talking.
Good morning. I have no idea if you can hear what's going on.
On the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
Of excessive monetary policy has, made the average investor sort of complacent.
I don't think that the market is adequately pricing in quantitative tightening.
Increasing concern, I think, about the cumulative impact of the tightening cycle.
Liquidity withdrawal from quantitative tightening that we've never experienced before.
New and unpleasant reality here.
Looking now at credit spreads in the mid 400s, and they just look too expensive to me.
Maybe markets got excited about a Fed pivot.
What would it be that would cause them to pause rate hikes?
This time they're not going to, unless something really bad happens.
Live from Jackson Hole, Wyoming this morning. Good morning. Do you know why I became a news anchor? Because I couldn't do this.
Oh, yeah?
My first job was on the studio floor. My first job was on the studio floor, and I was absolutely shocking at it. And I think I lasted 2 weeks, and they were like, get into the newsroom. Just get into the newsroom and stay away from us. What a tremendous effort to take us inside and then bring us outside and have us all around one table together again, Tom.
Yeah. Well, we're here, and it's going to be exciting to get through this Thursday and onto a far more important Friday, but it's also about taking in the why they're here. They're academic papers. They're like watching paint dry. The only one that reads all of them is Michael McKee. Nobody else reads them. He sits there with a pencil and goes through all of them like this. And then there's the other stuff, which is the conversation. And to me, John, the international conversation of the U.S. doing better is front and center off of claims this morning.
When you see Esther George a little bit later, are you going to tell her that this event sometimes is like watching paint dry?
Yeah, I told her that last night.
How did that work
She threw a drink in my face.
Chairman Powell tomorrow, we'll hear from him at 8 a.m. local time, so that's 10 a.m. Eastern time. And Lisa, the market, as you know, has got a lot of questions.
Yeah, especially because right now they're not buying what the Fed is selling. The Fed is trying to sell them that they're trying to fight and tighten financial conditions, and the market's saying, nah, we don't buy it.
Futures this morning, Tom, positive about 0.4% of 1%.
Yeah,
to my point.
There's a little bit of move, and the yield move. It wasn't much off the economic data. The data points here, I've seen two moose, and two jackrabbits just went by, and they haven't lost their horns yet, John, which is great.
I can see a Megan Green alongside you as well.
Okay.
Yes, and she's furrowing her brow. What did I get myself into?
Global Chief Economist at the Kroll Institute joins us right now. Megan, what are you expecting over the next couple of days?
So I think Chair Powell is going to say that the Fed's really serious about inflation, that they're going to have to raise it enough to bring rates enough to bring inflation down. Yep. I think he's not going to say that they don't know exactly how high that's going to be, but there's a lot of data to come out still before the September meeting. So I think that's why markets are perfectly straddling a 50 basis point hike and a 75 basis point hike. There's just too much that we don't know. And the economic data has been really confusing, even for economists, right? The soft data is all pretty terrible. The hard data is pretty good, though, so it suggests that a recession's a ways off, but we'll see whether, the hard data catches up with confidence fairies or the other way around.
Megan, you own the franchise of the transatlantic. You've been on both sides academically and also in your professional career. I looked at two Bloomberg Financial Conditions Indexes yesterday. I went back 30 years, and the word is never. We have never seen a financial conditions partition like a Europe at war and the United States doing better. How important is that to the Powell discussion?
I think it's more important for the ECB actually than it is for the U.S. because the biggest implications are really in terms of FX. That's why you've seen the euro go through parity, and I think we'll see it sink lower. So I think the U.S. is kind of the gorilla in the room. The Fed is the world's central bank. And dollar moves affect the U.S. economy, but not massively. I think the bigger implications are for Europe.
So right now it sounds like everyone's saying there's not much that Fed Chair Jay Powell can say tomorrow that's really going to change anything. And yet the markets seem to be gearing up for a really big change, and everything is moving in tandem. What could they do to redefine the narrative, to take hold of the intellectual leadership at a time when that has been the main criticism of the Fed, that they have been behind and they've been wishy-washy?
So they can only do what they have been doing for several months now, which is to say, okay, we get it, inflation's staying high, and we're really serious about it. I mean, I think we have seen peak inflation, so to some degree, I think the Fed's job should get a little bit easier on that basis. But I think all that the Fed and all that Chair Powell really can do is to highlight, hawkishly that they're really serious about inflation, and they're not going to pivot so that, market pricing of rate cuts already at the beginning of next year are probably off the mark.
You think that's ridiculous, don't you, that we're talking about rate cuts already?
I do, even though the economic data hasn't been fantastic, right? I, like many economists, have been calling for a recession next year, but I don't think that the Fed's going to be cutting rates at the beginning of next year.
8.5 CPI now. What are you thinking that comes down to by year end?
By the end of this year,
yeah.
I think it'll be great if it were down by 6%. But I also think that the trajectory is more important than the actual level. I think the Fed would be pretty happy with 3 or 4% inflation if the trajectory were really clear. And I think we should start to see the trajectory improve.
The trajectory is part of it. I got all these T words: transitory, trajectory. To Karsten's brilliant interview with Chris Giles today in the FT, is there a theory here? Because Karsten's is adamant the Phillips curve is really difficult right now. Is all this mumbo jumbo here, are we making it up as we go, or is there an underlying theory you can glean at Jackson Hole? I don't glean it.
Yeah, no, look, the world's never been through this before. We've never put the world on ice, the global economy on ice, and then defrosted it. And so I think we are flying blind to a certain degree. We have theories that kind of underpin it. I don't think it's the Phillips curve. I don't think the Phillips curve really holds up.
You okay?
What's the matter with you?
I just had to sneeze. It's very awkward. It's very awkward to sneeze on
She's
air.
never been in air this clean.
I just got a message from a Bloomberg subscriber. Someone alert Meghan to the bear disguised as Inspector Clouseau next to her. She's in danger, I'm told. Meghan Green, thank you.
No, we're not. Thank you. We're not done.
We are.
No, we're not done.
You're
Meghan, very quickly here. The Red Sox are a train wreck. What do they need to do to begin to rebuild for next year?
Oh, God. They need to deepen their pitching bench, I think, more than anything else. Yeah, that's right.
Maybe they get healthy.
I think that would help a lot. But
okay,
you've done that.
Now we can end
the conversation.
Now we can end.
I love it. Tom was brought out here to say it's like watching paint dry. They're not going to say anything. It's mumbo jumbo. Let's talk about the Red Sox.
I think theory is distant here. I think they're to a huge extent going from data point to data point, making it up.
I have to say, Tom, so's this market. The narrative seems to change from one data point to the next, Meghan.
This is why we're giving up on forward guidance. This is why we're giving up on forward guidance. It just depends on the data. We can't come up with a theory in advance.
But then what is all of the discussion? And why are so many Fed officials coming out and trying to give us guidance?
Yeah, because they're trying to give everyone a sense of how they're thinking about things so that as there are developments, there won't be big surprises on how they'll respond to them. But the data's, all over the place.
So Megan's
it's difficult to come up with
their job
real
now
theory.
is to establish clearly what their reaction function is. That's what we need a better understanding of. If unemployment's going to start climbing at year end and inflation's still at 6, like you indicated, Meghan, what do? How high is the hurdle for a pause? Never mind a cut.
And how much cohesion is there among Fed officials on what that reaction
They do what
is right
Hatsi
now?
has said. Time is their friend. They just delay all the market structure that says lower rates, cutting rates, all this
I'm still trying to adjust to Neil Kashkari, the new hawk on FOMC.
Yeah, and then Esther George.
Or Esther George, the new dove, exactly. Yeah, they've swapped.
Reversal. Savita Subramaniam is going to be joining us very shortly of Bank of America with equity futures up 0.4 on the S&P. Inspector Clouseau. Live from Jackson Hole, Wyoming this morning. Good morning. This is Bloomberg.
The public seems to have lost interest in waiting around for self-driving cars. I rode in Google's self-driving car in 2011.
Wow.
And I'm still waiting to be able to buy or just ride a self-driving car on demand. Why is it taking so long?
I think in self-driving, first of all, the opportunity is so clear. The reach is so broad. We forgot that big things do start small. We all know how to drive, but we're driving amongst humans, and you have to deal with so many little scenarios. There are so many things that you've been learning about driving since birth. And codifying that using AI, sensors, and computers is turning out to be a lot harder. Last but not least, it's a safety-critical system. None of us should deploy until and unless we have closed-loop evidence that we're safe.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco. No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
From New York City.
We're in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Don't you think we need that soothing Jackson Hole music to go with this backdrop?
We do.
Just, that
1955, I thought it worked out.
What about the opening bell?
The opening bell
That works too.
Doesn't really work with the soothing
Equity
music.
futures going into the opening bell, negative about 0.4% on the S&P 500.
First print on the Dow up 100 points.
There we go. Thanks for that.
Thanks
That's
for
an
that.
original
That's
moment
news you
for this
can use.
program.
Yeah,
because
exactly.
let me tell you, that doesn't often get a quote.
32,972. America's index
Are
is
you
green on the
trolling me
screen.
on my own program?
Exactly
Is
what
that
it
what
is.
you're doing?
I am. I'm looking for elk, and I saw 2 jackrabbits, so we're having a good morning.
Unbelievable. We're falling out over this. The Dow.
The Dow.
Yields, bond yields in, down 3 basis points on a 2-year, 336. Taylor Riggs has some of the opening bell market action. Hey, Taylor.
No doubt here, John. Only fundamentals for you. Take a look at NVIDIA. Of course, some of the quarterly results coming up yesterday after the closing bell. And we did a whole full 30 minutes on still some of the chip makers that are showing signs of struggling. And you certainly see that just a little bit with NVIDIA, of course, this morning. Third quarter revenue, $1 billion short of estimates and about $2.5 billion short of where the estimates on the street were just a few weeks ago. Second quarter gaming revenue also down about 33%. Take a look at shares of Peloton as well. Another 7th miss in 9 quarters, erasing some of the big gains that we had yesterday on the Amazon news that they're going to be selling some of their bikes there. So MKM Partners coming out and calling it this morning just another sort of big down miss here for this company. Snowflake big to the upside, John. You're up 19%. This is a $50 billion cloud data software company. Of course, second quarter product revenue up 83%. Alibaba, I'll finish it here for you. You're up almost 4% or so. You're looking at the mainland government, looking at maybe a 19-point stimulus plan. China big tech on the rise today, John.
Hey, Taylor, thank you. If you're just tuning in on TV and radio worldwide, we are in Jackson Hole, Wyoming for some special coverage for you of the Fed's annual get-together. We'll hear from Chairman Powell tomorrow morning at 8 local, about 10 a.m. Eastern time. Tom, something has crept back into the conversation in this market. Crude, Brent, 102.
This is a story not being talked about, and I think what's so important here is the bulls were vanquished. There was a hue, and we were in London last. And you weren't there, it was with Lisa. We were in London, and JP Morgan was adamant about the structure, 120, 150. They were vanquished by the bears, who sort of got what they wanted. I mean, Ed Morrison Company.
For a moment, for a heartbeat.
90, and all of a sudden, we're up $15.
How much does this gain some of the momentum heading into September, October, when the Strategic Petroleum Reserve stops?
And what's important here is Francisco Blanch of Francisco Blanch of Bank of America was adamant about the complexity of the moment in commodities.
What do we have? 70 straight days of gasoline prices.
71.
Petrol coming down. And then picking up again
a little
recently.
Dig.
It's not a dig, I'm joking. Bank of America, Savita Subramaniam joins us now. And Savita, fantastic to have you with us. I wanted to start with a note that you actually put out a number of weeks ago. And the title was something like, why are we so happy with 8.5% CPI? Savita, why was this market so happy with 8.5% CPI?
Look, I think that part of it was the idea that we're off peak. But our point was, sometimes the second derivative doesn't matter. Sometimes it's the first derivative you want to pay attention to. And 8.5% CPI is really far away from 2 or 3%, which is what we believe the market is pricing in. I think that, when I hear the bullish arguments for, kind of justification for the rally that we've seen from July, or, from June, I guess, it's two things. It's one, we've moved past peak inflation, but wages are still strong, so the consumer is still going to be okay, therefore soft landing. That's one bullish argument that I disagree with. And the second bullish argument that I disagree with is that we've seen earnings better than feared. We've seen results better than feared, and everybody points to really strong top line and 15% sales growth for the S&P. The problem with that is that most of the work for sales was coming from energy. Energy grew sales by 80%. Everything else was fairly lackluster. And then when you adjust for inflation, when you take that 9% print of inflation out of 2Q sales, the sales for the S&P 500 ex energy were essentially flat. More companies in the S&P 500 undershot inflation in sales, couldn't grow sales faster than pricing, which is really, kind of a weird setup versus the other half that managed to beat CPI. So I think that what we're all looking for are reasons to get more bullish, but the reasons are pretty thin, if you ask me. On peak CPI and still strong job costs, I mean, I see that as still strong labor. I see that as overwhelmingly negative, because what that means is pricing power for the average corporation is starting to wane, demand is starting to wane, but wages, which are the biggest depressant on corporate margins for the S&P 500, are sticky and high. I mean, why are we celebrating about this? I just don't get it.
That was the essence of your note, Savita. We caught up with Mike Wilson of Morgan Stanley yesterday, who's very much on the same page as you at the moment on some of these issues. Take a listen to what he had to say.
The whole fire and ice narrative is coming back into play. We're in a downtrend. And until the market can get back above that downtrend, I think to be making some grandiose call about new highs is quite frankly, it's irresponsible given what's going on with the Fed and QT coming, as Bob laid out. It's going to be a lot worse than people have experienced so far. Price is wrong and the earnings are wrong again, which means the attractiveness of risk reward today could be almost as bad as it was back in January.
Savita, you're back at 3,600 on the S&P 500. That's your forecast. What's the Fed's role in that move lower that you're looking for?
Look, I don't think the short end of the curve and what the Fed's doing at the short end matter as much as the long end. And I think that what's bizarre to me is that, I think this laser focus on, sort of inflation prints and on a monthly basis and real-time reads on inflation. And what is the Fed going to do? Are they going to hike 50 basis points or 25? Are they going to start cutting? I think all of that is second to what happens at the long end of the curve. And, I like that phrase, complexity of the moment, because I think this is a very complex moment for equities. And the reason I say that is the duration of the S&P 500 is still above 30 years. We're looking at a 30-year zero coupon bond. So what that means is that a mere 50 basis point change in the cost of equity capital, which is more influenced by the long end, could drive the market either really high or really low from here.
Right.
And I think that's what makes up the complexity of the moment for equities.
Savita, Brian Moynihan takes immense pride in studying the granularity of American business. It is the franchise of your Bank of America. What are you and the sell side at Bank of America, the research analysts, what are they saying about how corporations are adapting and adjusting to these complexities?
Well, you know, you're right. So corporations are adapting and adjusting, and it's really marvelous to watch. But I think that what that requires is a fair amount of capital spending from the big multinationals that are in the process of, you know, rejiggering supply chain, which is a complicated and long process that costs a lot of money. They're also in the process of automating labor, which has gotten that much more expensive. So this is all really good for long-term productivity of corporations. We haven't seen a real CapEx cycle in a long time because earnings have been buoyed by low rates, buybacks, all sorts of machinations that aren't real economic growth. But I think what we're seeing now is the beginnings of a real, you know, a real growth cycle driven by companies getting more productive. And that is very bullish for the S&P 500. Unfortunately, I think it takes a little while to get there, and it also costs a lot in terms of capital spending. So what we like within the market are the more domestic plays that could benefit from that CapEx cycle. And Jill Hall, our SMID strategist, has been talking about this, you know, on your show quite a bit. So I think that's a great area to start to deploy capital, but multinationals for the time being, yeah. I mean, I think multinationals.
No, it's bullish talk. It's bullish talk from Savita.
Well, hold on a second, Savita. This is actually exactly where I wanted to go because basically everyone's calling me a bear and dressing me up as one on the internet. But I am wondering, from your perspective,
Who's doing that to you?
well, there was a bear
It's
head.
like a mean thing.
Yeah,
Like put a
which is
bear
okay.
head on top of
I
it.
accept it. I embrace it.
That happened to me
I'm not
before as
scared
well.
of it.
Yes.
I will just say that there is this sort of bullish tilt. There is no. I embrace it. But if you know, what is the after 3,600, right? This is the distinction between the long-term bulls and the long-term bears, right? 3,600, is that the new low that is catharsis that then leads to adjusting and adapting of Tom Keene? Or is this a more protracted loss in the momentum and, frankly, the valuation of U.S. equities?
Look, I think this is all happening at a warp speed. So at the beginning of the year, our long-term model was pointing to negative returns for the next 10 years. Today, the good news is that after this massive drop in the market and lower, not low, but lower multiples, that model is spitting out, you know, mid-single-digit returns for the S&P 500 for the next 10 years. That's a much better setup, a much better entry point. I do think that point-in-time targets are fraught with all sorts of problems. But I will tell you this, I think that the fact that just a mere 50 basis point change in the cost of equity capital, either long rates or the risk premium, could drive us to our target of 3,600 makes me worried about the downside risk.
Savita, I got a key question. It's for all of Global Wall Street. They know you own the high ground on ESG investing. Essentially, you invented it. Is ESG investing dead? Where is it in a year? I'm serious. Where is it in a year?
Well, you know, I think what the problem right now is that investors are throwing the baby out with the bathwater. And we've done a lot of great work on, you know, and we've talked about our work on your show. ESG investing is nuanced. It's not one size fits all. Different sectors have different factors that are more important for driving, you know, social factors are more important for labor-intensive innovators. Environmental factors are more important for energy and materials. So it's not just some kind of, you know, one-size-fits-all, apply this rating to your entire portfolio and you're done. But we do think that there are a lot of ESG considerations that are being ignored in this, you know, kind of refusal to even think about ESG in an environment where it's drawing a lot of fire. So I think it's a complex, nuanced topic, but I still think that there are lots of ways to make money.
John, this is a huge deal.
I agree with you.
Huge. She invested a lot of time.
I remember catching up with Savita and you. Was it in Davos? How many years ago was that?
It was 3 or 4 years ago.
Something like that.
She and Brian Moynihan said, we're going to actually do the math of ESG, and that's where they provided leadership.
Who would have thought we'd be talking about coal all over again in 2022?
Exactly.
And talking about burning wood in parts of Europe as well.
Well, let's revisit this morning. We failed at this today because of all the weather issues here and a great team. The real story this morning is Netherlands nat gas broke out to new highs.
Breaking
Maybe
out
you
again.
covered it when I was inside.
We did.
Taking my siesta.
When we were sitting next to you and you weren't listening. It's just not an original moment. In fact, I remember it quite clearly. I think I was speaking to Tom at the time about European gas. Anyway, Savita, you're going to be sticking with us, I'm pleased to say. Savita
I didn't know that.
I'm pleased to say that, Savita, we listen to you. Do you listen to your guests ever?
No.
What about your co-anchors? No?
Even less.
Okay. Good.
Look, I just want to tell you, Benoit Carré, the great French economist, emailed in, and one of his colleagues, this is years ago at French Chasseur, the economist Clouseau, he said, for Jerome Powell, this is a shoot, shoot, bang, bang Fed.
A shoot, shoot, bang, bang Fed.
I can't do the accent. The shoot, shoot, bang, bang Fed.
You know the beauty of you, Tom, is that you just said the economist Clouseau, and someone out there thought, where does he teach? Where does he teach?
Yeah, exactly.
Where does he go for the
Fisherian?
Where was Rocher?
We're counting you down to Chatham House speech at 10 a.m. Eastern Time tomorrow from the beautiful Jackson Hole, Wyoming. This is Bloomberg.
Fascinating entrepreneurs because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably couldn't spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, and the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
Happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic. This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
An entire generation is now saddled with unsustainable debt in exchange for an attempt, at least, at a college degree. The burden is so heavy that even if you graduate, you may not have access to the middle-class life that the college degree once provided.
The President of the United States fulfilling a campaign pledge, and TK, a controversial one. That, I'd say, in the last day or so.
Yeah, just not to waste a lot of time. Jason Furman with us tomorrow. I think he's on Team Biden, scathing in his critique.
Jason Furman is on with us tomorrow. And Jason Furman, like Larry Summers, at times, Lisa, has been a bit of a headache for this administration.
In particular with the inflationary impulse of some of their stimulus, of some of their plans, and how much does this sort of feed into that? On the margins, not significantly, but basically giving people more power to spend at a time where that's a problem.
That argument, to me, is second tier to the top tier argument, which is they've started a process, and as Meghan McArdle in the Washington Post says, once it gets started, what's next? What's the next program after this?
What about me? It's the phrase you heard a lot.
So, you know, one of the Abramowitz clan gets into something that costs $80,000 a year, and you go, wait, the people 5 years before me got tuition relief. Where's my tuition relief?
As you say, Tom, the $80,000 a year, though, that's the heart of the problem, isn't it?
Oh, absolutely.
Yeah, I'm sitting here like, why are you pledging that to me?
I mean, we would all go to a sane...
I'm really sideways.
You're
wrong about himself anyway.
We would all go to a
Emily Wilkins joins us now from Washington, D.C. Emily, how controversial is this one proving to be?
So this one is even controversial within the Democratic Party. I mean, you've seen some lawmakers like Bernie Sanders, Elizabeth Warren come out and praise the Biden administration for it. But you've seen other groups, notably the NAACP, saying that this really did not go far enough. And then on your more moderate Democrats, we saw one, Chris Pappas. He's a frontline Democrat. He's going to be running a very competitive race in November. And he said, look, this doesn't really address the main problem, which is that college tuition is too high. And we need to find ways to bring that back down. So a lot of mixed response here, a lot of criticism from Republicans. At the same point, what Biden seemed to really do here was kind of choose that middle ground. He didn't go as far as Warren initially pitched on the campaign trail with $50,000 of relief. He went for a smaller number. He limited it to those who make less than $125,000 a year.
Right.
And he tried to really focus it on low-income students, offering
Emily.
those with Pell Grants.
Emily, go Spartans on us here. What is the distinction between University of Chicago at 81,000 all in Michigan State at a number that's a little bit beneath that? How are those two schools treated in this new legislation?
Well, to a certain extent, if you see schools, there's an argument out there that if schools see that the government is willing to forgive student loans, that doesn't really incentivize colleges to try and keep their tuition prices low. And let's also point out, I haven't heard this in the discussion too much, but the federal government has already forgiven hundreds of billions of dollars of student loans through numbers of other forgiveness programs. They've had their public service loan forgiveness. They've had other programs where after you pay a certain month for a certain amount of time, you get the rest forgiven. So Americans have already been footing the bill for a lot of folks who have gone to college and racked up a lot of student debt through these other federal government programs. And you'll hear folks, particularly on the right, but even some on the left, say that they're concerned that some of this government aid that's been going out there, it really has not incentivized colleges to try and figure out ways to keep tuition low. And so we're going to see folks increasingly saddled with more and more debt. And then the question becomes, do you start seeing things like Biden's move yesterday become more common?
Yeah, Emily Milkins of Bloomberg Government, thank you so much for being with us. The underlying question here really has become also, though, how protracted is the inflationary impulse if you start to get increasing numbers of programs that do aim at increasing the spending power of a whole swath of individuals, which brings us to the Jan Hatzius call. Savita Subramanian of Bank of America is still back with us. What is your view of the ramifications for equities if the Fed were to hold rates at 4%, 3.5%, for years in the face of some of these structural changes fueled by fiscal policy?
You know, I think that is essentially what the market is pricing in. I mean, my view here is that, you know, what we're seeing now is actually a healthy, although, you know, somewhat volatile return to normalcy. I mean, I thought that, you know, by the end of June, we had positive real rates, and then they retraced quickly back to zero. So I think part of what we're seeing is a move towards a rational market with a rational discount rate. You know, holding rates fixed, I think is, I mean, I just think that we need to let some of the leverage grow more expensive in order to shake out, you know, kind of excessive spending, excessive leverage levels, which, you know, fortunately aren't sitting on consumer or corporate balance sheets, but are sitting on government balance sheets. So, you know, I think the other argument that we hear around, you know, why we should be bullish is the idea that we have so much debt that the government can't afford to let rates move higher. I think that's actually a very bearish sign that we are in this, we've gotten ourselves into a box, basically, where we have to keep rates low forever in order to shoulder this burden of debt. You know, I guess I look at a lot of the fiscal responses to this, and I think, you know, some of it's good. I mean, if you look at the green spend outlined in the Inflation Reduction Act, I think what that does is it shows corporations that they're not alone in getting to net zero, in reducing their emissions, and that the government is going to help along the way. But I also think that this pulls forward a lot of CapEx spending that companies were planning to do over a longer time horizon. Now they're going to pull it forward into the next 5 years. So, you know, if you think about it, the easiest way to get to lower emissions is by moving your operations closer to your consumer. And that's what we're seeing most companies do. In fact, our analyst base asked our companies, how are you going to reduce emissions? And one of the most frequent responses was reshoring, nearshoring. So, you know, the Inflation Reduction Act, I think, is really interesting in that it does encourage moving to that goal faster. But what it might also do is push inflation up as companies spend more aggressively on CapEx as this tax benefit, you know, basically lasts for about 5 years. So, you know, it's complicated. I don't know if keeping rates low forever is the answer. Thank you. Thanks.
It's certainly not. Savita, thank you.
John Taylor would say no.
Savita Subramanian, I think John Taylor's saying no, isn't he? He said no.
He was really, it's amazing how many people are coming around to some form of not so much the shadow days of your Charles Plosser and the rest, but to what John Taylor's saying is we need to right the system.
Proper hawks. Can you imagine if Charlie Plosser and Richard Fisher were still here?
Can
you imagine where they'd like rates to be?
I give Krugman credit for this. I may be wrong on this. The inflationistas, what do they do in a time of 8.8% inflation? We're there.
We're there right now, 8.5%.
Yeah, well, at what point does everybody have to become an inflationista? Yeah. And would they have gotten ahead of it, right? Would they have been more aggressive about pushing the hand a little earlier?
The beauty here, the elk in the distance, and there's two moose way over there. I can barely see
I can tell you're distracted.
A flight of yellow-thumped warblers just went right by, and it'll be beautiful here tomorrow.
Okay, are you going hiking today?
I am. Okay, I got up to 6,000 feet. I'm trying to get up to 8,000 feet today.
Yeah, okay. You enjoy. Inspector Clouseau, going on a hike a little bit later.
Economist Clouseau.
I'm going to take Bramo for breakfast. Live from Jackson Hole, Wyoming. Looking forward to the coverage continuing through today with Kathleen Hayes and Michael McKee. This is Bloomberg.
and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
What is your base case for Italy in terms of what happens politically and then what the economic fallout is?
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The tag on the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Added the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, There were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benagold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Venergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Venergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not 0, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And well, space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say,